Good morning, students. Welcome back to the session on audit. And today we are going to discuss various auditing standards as we discussed yesterday. We are now first of all starting with auditing standard on the estimates. SA 540, which deals with accounting estimates, fair value accounting, and the disclosures around this. Accounting estimates, actually if we talk about the fair valuation, this is also an accounting estimate, and the disclosures around all of these estimates are very critical in relation to any financial statements. And practically what we have seen that in most of the places very less importance is given to these areas, not only in terms of accounting but also in terms of the audit. And there are some reasons behind this. There are some inherent problems which are attached with this. When it comes to an accounting estimate, we understand that estimate can never be actual. It is an approximation. In relation to any item, if that has to be estimated in terms of its amount, we understand that precisely we cannot get onto an amount which can be considered to be its actual value. It is always considered to be an approximation. For example, when we get actuarial valuation done in respect of employee benefits, various assumptions are used by the valuer, who is actuary in that case, by the management, who has to support the actuary for that valuation. And on the basis of all of those assumptions, valuation technique is designed by the actuary, which results in an amount which is recorded in the financial statement. Now we have discussed about some assumptions. The moment we talk about some assumptions which are used for the valuation, we can understand that these assumptions may change. Some of the assumptions may change or might be changed by the management or by the valuer intentionally, and some of them could be unintentional. Let's say if the entity doesn't want this valuation to be higher, they can just change the assumptions. They can do this manipulation in the value easily because everybody would know that these are estimates. So even if these are higher or lower than the value at which they should have been recorded, it is not easy to track it. It is not easy to value it with complete accuracy. Similarly, when it comes to fair valuation, under Ind AS you must have understood that fair valuation is required for multiple items. Let's say PP is fair valued. Let's say any equity shares of a company are fair valued, which doesn't happen to be a listed company. Therein again, a lot of assumptions are used. And therein again, because the assumptions are involved, management may be in a situation to manipulate some of the assumptions and eventually manipulate the valuation which is attached to some of those assets or liabilities. And because of this risk which is attached to accounting estimate, there can be an impact in relation to all of these items in the financial statements. And that is why it is considered to be a very risky item in the financial statements. One, because the assumptions are involved. Number two, because it becomes more of subjective. Judgment is applied in terms of valuation. Judgment is applied in choosing a valuation technique. Because valuation techniques for valuation of any particular asset or liability may not be fixed, which has to be used in every case. It may have to vary on a case-to-case basis. And that is why this auditing standard is very focused on, and this is considered to be very important. We have talked about various reviews yesterday. I'm not only talking about the review which is required on the part of auditor on the financial statements, I'm also talking about the reviews which the auditor becomes subject to from the regulatory side, from the ICAI side. In relation to all of those reviews, one of the items which is considered to be critical and which is always evaluated by the reviewer happens to be accounting estimates. That means how did the auditor audited these accounting estimates? And more importantly, that in relation to these accounting estimates or these fair valuation, etc., what were the disclosures? Because these are largely ignored in the financial statements. In the financial statements, four things are required to be considered in relation to any item: recognition, measurement, presentation, disclosures. Recognition and measurement are generally considered by every entity, because every entity understands that it will be difficult to hide the recording of any item, because there are ways to capture it. Measurement, as we have seen in case of estimates, measurement can be a problem, but at least the item can be recorded. It may be recorded at 100 instead of 150, but at least the item will appear. And if the item will be recognized, it will have to be presented somewhere, for which there is a prescribed format under the Companies Act. One area which is ignored happens to be the disclosures. In respect of disclosures, they don't get the due respect which they should get in the financial statements. Because management believes that if they will ignore some of the disclosures, it will not matter. And the same thing happens to the disclosures which are related to these type of estimates on the fair valuation, etc. However, we cannot ignore the fact that disclosures are also coming from the requirements of accounting standards. And accounting standards doesn't give a choice to disclose. It is also as important as recognizing or presenting any item in the financial statement. So that's why it becomes important on the part of the auditor to ensure that all the required disclosures have been incorporated in the financial statements. And in case the disclosures which are essential, which are important, those are missing, that can have an impact on the assessment of the users of the financial statements. Some of the disclosures related to these items could be very, very important, because only when the user will understand about all of these disclosures, he will be able to understand how these accounting estimates were considered, how these fair valuation, etc. were considered. So this can have an impact on his decision making in relation to the entity. And that's why this also becomes critical for the user of the financial statements. And if, let's suppose, the company is ignoring any of the disclosures, which we understand is critical, which we understand is material, then from the auditor's side, it becomes a reporting obligation. And this can also have a reporting implication to even come up with a qualification, to even come up with a disclaimer if such types of disclosures are ignored in the financial statements. Now, talking about accounting estimates, we have discussed that this essay or this auditing standard deals with both accounting estimates, fair valuation, and the related disclosures. Now, what is the nature of accounting estimates? We have discussed that this is something which cannot be precise. This involves approximation. There is a degree of estimation uncertainty which is always involved in accounting estimates. And because of this, there is a risk which is involved. Because we are making it subjective, this is not precise, we are making it judgment on the part of management. So this can be impacted, and that's why this leads to a risk in terms of non-recording or maybe under-recording or over-recording of these items in the financial statements. And that will also lead to a risk of material misstatement, which may arise in relation to these items. And that's why for an auditor, when he will be doing the risk assessment, this will be one area which is required to be considered by him. Degree of estimation uncertainty. We understand that this estimation uncertainty is involved in this. Now, how will it vary? This will vary, one, on the basis of the accounting estimate, means the nature of accounting estimate, which will also depend on the assumptions which are used, the extent to which there is generally accepted method used to make that accounting estimate. That means when the valuation will be carried out, when the amount will be ascertained, then sometimes there are various practices which are developed. Say if we have to record valuation of any unlisted company, then in the market there must be practices in relation to recording of that valuation of unlisted equity share. Depending on that practice, generally the company will also get its valuation done, or the company may choose now not to follow that method, or maybe follow some other method if that is something peculiar to the company, but this will have an impact. This will have an impact on the overall valuation, and this will lead to change in the valuation. It can be lower side, it can be upper side. There is a subjectivity which is involved. We understand that all financial statement items, they do not require measurement at fair value. Okay, it's only about some of the line items. But whenever that is involved, that will again lead to a situation wherein the estimation uncertainty exists. And auditor will have to consider this aspect while making his risk assessment. He will have to consider what are the procedures which were followed by the entity in relation to avoiding this estimation uncertainty, or maybe in relation to coming to this number in a way that this becomes as accurate as possible. Now, when we talk about some of the valuation, all the items will not involve this estimation uncertainty. For example, if we talk about valuation of equity shares of a company which is listed, okay, whose equity shares are quoted. Now, in relation to valuation of such shares which are quoted on active market, which are quoted on the stock exchange, they may require adjustment if the holding is significant in relation to the market or is subject to restrictions in the marketability. But otherwise, we can understand that there is a good basis which has been considered, because we are picking up a valuation which is something quoted in nature. And because this price is quoted, then the estimation uncertainty which is attached to valuation of that uncertainty is already limited. There are no further assumptions which are considered by the management. Management is just looking at the quoted prices and using that quoted price for the valuation. So therein, even though this will happen to be an estimate, but the estimation uncertainty will be very, very low. Until and unless some adjustments may have to be made, which again would have been captured by that valuation in the market when it will be quoted, but still management may require some sort of adjustments. There could be some restrictions which are attached to that equity share. Say an investor might have invested in equity shares of a company and that must have been listed. So the investor can always check the valuation by looking at the quoted prices. But investor may be restricted in terms of not transferring these shares to any other party for next 6 months. Then when he will do this valuation, he may pick up the quoted prices, but he will have to adjust this. He will have to adjust the impact of this restriction. So only to the extent he will adjust this valuation, some sort of approximation will arise. Otherwise, it will not arise. So that is one aspect which may have to be considered. But when it comes to any unlisted company for which quoted prices are not available, then we are talking about this complete assessment which is involving estimation uncertainty, which is involving approximation. Now let's look at some more examples of accounting estimates. We discussed about fair valuation, we discussed about actuarial valuation. Let us talk about provision for doubtful debts, provision for obsolete inventory or old inventory, depreciation method, useful lives, the residual values of the PPE, provision which we make in respect of the investment, that means about the impairment of the investment. All of these are the examples of accounting estimates, which we also understand under the accounting standards or under Ind AS. These are same. However, looking at these estimates, we can just easily understand that there's a risk. Why? Because these are approximate things. When we look at the useful lives of any plant and machinery, we cannot be sure that the useful life which has been ascertained by the management on day one will continue to remain same. And that's why the standard also requires a reassessment of that useful life on an annual basis. Again, because there are certain things which are inherent, which are attached to this, because of which this useful life may keep changing. Maybe the economic environment could be such which may have an impact of that on that useful life. Let us suppose if we talk about the debtors, accounts receivables, in relation to those accounts receivable also, even though we will do this assessment as to what should be the provision that needs to be made, we may follow any of the methods, any of the approaches which may be available under the accounting standards or Ind AS, but still that may vary. That may vary on the basis of certain factors which even the organization may not control at times, because there is a third party which is involved. And that's why again, whenever these estimates are made, they require reassessment. And auditors should also be wary of this fact that even though estimates have been recorded in the financial statements, they will not remain fixed. So similar to what the management has done, or similar to what the management would be required to do, auditor will also require to do the same thing. He will have to just keep looking at all of these estimates. He will have to just reassess whether the estimates which might have been recorded by the management in the financial statements in a particular year or in a particular period, are those continuing to be same or should those be changed? So that means it's about checking whether the management has done this or not, which was required on the part of the management. There are certain fair valuation accounting requirements which may be related to some of the instruments which are considered to be complex in nature. When we deal with derivatives today, the derivatives could be various. Derivatives could be about the interest rate swap. Derivatives could be about the cross currency swap. Even if we talk about the share-based payments, fair valuation is considered in relation to these items or these instruments. And these instruments are generally considered to be complex in nature. Because of the complexity which is involved in relation to these instruments, the terms and conditions of the instruments are such that its fair valuation is also not considered to be easy. And the moment we say it's not easy, again it becomes judgmental also. And that's why these items should also be properly evaluated by the auditor when he will do his risk assessment. Management bias. So far, on the basis of our understanding, we are clear that judgment is involved, approximation is involved. That's why there could be a manipulation. There could be a manipulation in terms of valuation. We are not saying this will always be intentional. This may also be unintentional, but definitely something over which management can have a bias that anyways becomes a risk area for the auditor. And management may have a bias. Why? Because management may want to show more profits during the year. So if they want to show more profits during the year, they may fair value some of their instruments at a higher amount, which will go to P&L. I'm talking about some of those instruments whose impacts will go to P&L and through which they will be able to show a higher profit during the year. Similarly, management may not have an implication to show higher profits. They may want to cut down on their profits, which could be related to the taxation reasons. Therein again, they may show a lower value. And this can be easily done by the management, because this fair valuer who will be helping the management will also be an expert of the management. If you remember the discussion about the expert that we did yesterday, in relation to most of these estimates, expert is hired by the management. Management doesn't always do this on its own. Generally, expert is hired. And because that expert is hired by the management, expert is nothing but an extended arm of the management. And that's why he will be working as per the instructions of the management. So if we say that, let's suppose actuary is doing this valuation, if we say let's suppose a fair valuer is hired and he is doing this valuation, so how come there is a management bias? There is a management bias because he is working as per the instructions of the management. He is not independent. He is fully involved with the management. That's why there could be a management bias, even though a party is going to be a third party. And that's why, again, this needs to be considered as a risk area for the auditor. Now, what will the auditor check? Auditor will check a couple of things. One, that the estimate should have been recorded at the reasonable amount, or the amount over which proper judgment, reasonable assumptions have been applied, and the disclosures are complete. So now let's look at the responsibilities and the audit procedures in relation to these accounts. I can just tell you that again, practically, when you will be dealing with these areas, this area in today's times is considered to be very critical. So that's why I'm saying not only theoretically, but practically also, these procedures on the part of the auditor are very important for your understanding. Risk assessment procedures. Risk assessment, we understand that there is risk involved in this. So when the auditor will do his risk assessment, he will have to consider all of these items. He will have to consider which all accounting estimates have been covered. Now that again is a problem, because many a times what we have seen is that it is very difficult on the part of the professionals, it is very difficult on the part of the management to bifurcate between the items which are involving estimates or not. So I'm saying we will do an audit of accounting estimate when we understand estimate is involved. But let's suppose if we don't understand where the estimate is getting involved, will we be able to apply those procedures? No. So that's why a thorough understanding by the auditor in relation to items over which estimate is involved is very important. And that again will require understanding of the processes, understanding of the procedures which the management would have considered in relation to the valuation. So I'm talking about measurement now. I'm not talking about recognition, because once the auditor will understand the measurement basis for all the items, or I should say all the significant items of the financial statements, he will be able to understand in a better manner that whether estimates were involved or not. And only after that he will be able to assess the risks. He will be able to identify the risks, and then he can take the necessary action. The next part, which is important on the part of the auditor, is the internal controls of the management. So now the auditor has identified accounting estimate. Auditor has also identified that in relation to the accounting estimate, there are risks. So some of the risks should be significant, some of the risks may not be significant. So we are talking about both the type of risks. Now comes the time to address all of these risks. Means auditor needs to come up with the procedures that he will perform in relation to all those types of procedures. In relation to all those types of accounting estimates. Now for doing that, the first thing which the auditor does always is looking at the internal controls. Is looking at the policies and procedures of the management itself. By looking at the internal controls which will be attached to that particular process through which estimate would have been computed, auditor will be able to understand whether the process was carried out in an appropriate manner or not. For example, let's suppose fair valuation of a derivative is required to be carried out. Now, in relation to this fair valuation of a derivative, let's suppose two fair valuers are available. Now, which one needs to be chosen by the management? Is it that the management doesn't have any focus of proper fair valuation, so that's why whoever is charging a lesser amount for the valuation, this task has been assigned to him, even though he is not competent, or even though if we understand from the management that this assessment was not done at all, then it becomes riskier for the auditor. The risk in such a case will increase. However, if we look at a situation wherein before hiring any fair valuer, management carried out all the procedures in relation to evaluation of that fair valuer. Means its competence was analyzed, his qualification, his work experience, his experience in relation to the particular industry, his experience in relation to valuation of that particular instrument was properly checked by the management. And then the task was assigned to that fair valuer. What does it imply? It implies that there are good practices which are followed by the management. The control mechanism of the management is good in relation to capturing any of these items in the financial statements. And that will give more comfort to the auditor, because basis this he will be able to understand whether the valuation which would have been carried out by the management itself would be a correct amount or not, and accordingly he can just decide his additional procedures or incremental procedures which he will be required to perform. Estimation uncertainty. So we discussed about estimation uncertainty, then in relation to accounting estimates this is involved. So auditor will have to understand what were the assumptions which have been considered by the management. What are the alternative assumptions which are available or which were available but which have not been considered by the management? Let's say, for example, actuarial valuation is required. For the purposes of actuarial valuation, I'm sure all of you must have seen this valuation for employee benefits also. A discount rate is considered. Even if I talk about fair valuation of any other item, a discount rate is generally considered in that. Now, what is going to be that discount rate? Who will choose that discount rate? It will be the valuer. But when the valuer has picked up that discount rate, then what is the basis of this? Let's suppose he has picked up a discount rate of 7.5%. So we understand that the valuation will change the moment we change the discount rate. Now, whether that discount rate is appropriate or not is something which the auditor needs to assess. And he will have to check the alternative assumptions also which were possible. Some of the alternative assumptions could be in relation to, even if I continue our discussion on the actuarial assumptions, could be in relation to the mortality rate. When the actuarial valuation will be carried out, mortality rate will be considered. The rate at which employees move out of the organization, that is also considered. And if we make the changes in that percentage, the valuation will automatically it may go up and down. And who may have this assumption? These assumptions to some extent are available with the management and to some extent are available with the valuer. So that's why auditor needs to assess whether the assumptions have been considered appropriately by the management. So far, auditor is not bringing in his own assumptions. He's just evaluating what was the mechanism which was considered by the management for choosing these assumptions. And of course, then he'll look at the recognition and measurement criteria in relation to recording of that item in the financial statement. Disclosures. Disclosures, as we have discussed in relation to accounting estimates. What are these disclosures? These disclosures basically comment about some of the things on the basis of which accounting estimate would have been measured. For example, this discount rate that we talked about, this is an assumption. So this is required to be disclosed in the financial statements. In relation to actuarial valuation, if you would have seen the actuarial valuation report, there are many assumptions which he follows. All of them are required to be disclosed in the financial statement. The basis of his computation, the movements in the valuation are also required to be disclosed in the financial statement. As an auditor, it now becomes important to do risk assessment in relation to these disclosures also. That whether these disclosures are important or not. And if those are required by the accounting standard, they anyways will become important. In relation to some of them, amounts may not be significant. But still, disclosure is an explanation of the item of the financial statement. And that is why its disclosure is required to be evaluated by the auditor. The next point is around the written representation. So basically it's about the management representation letter, which we discussed that in relation to the financial statements, written representation is required. When the financial statements are audited, management will provide this written representation. Now this written representation should also specifically cover all of these accounting estimates. This should cover whether the assumptions which have been used for the purposes of valuation were appropriately considered by the management or not. Management should give a specific declaration to this effect in the form of this written representation. So this becomes all the more important because unlike in case of any other item wherein the document would be available for the auditor to test, in relation to estimates, documents are generally not available except for the valuation report or except for the report on the basis of which measurement would have been done. Yeah, so auditor needs this important understanding or this important declaration from the management that yes, all of these were considered by looking at things in a reasonable manner. Okay, now basis this. So this flow chart basically captures most of the points that we have discussed. Now basis all of these evaluation, auditor will conclude his work. And in terms of conclusion, he will have to apply various procedures. He may have to apply testing of controls. He may have to apply substantive procedures which can involve testing of some of these items or which may involve analytical procedures. When it comes to testing of some of these items, let's understand what can those some items be. Again, I'm just continuing on that example of actuarial valuation. When the actuarial valuation is carried out, actuary will use some assumptions, but the data of employees for which this valuation is required to be carried out is not available with the actuary. This is company specific and this is provided to the actuary by the company. If the company has 500 employees and they provide the data to actuary only for 400 employees, then what will the actuary do? Actuary will do the valuation only for 400 will the actuary be able to find out another 100 employees? No. And is the responsibility of the actuary to ensure that all the employees have been captured in the data which has been shared by the company? Again, no. It's not the responsibility of the valuer. Because valuer is not doing any audit or review. Valuer is just looking at the data which has been shared by the management and providing the valuation. Now let's suppose if the management would want to manipulate this valuation, this can easily be done because they may not share the complete data to the actuary. And that's why when we look at the audit procedures, we also need to look at all of these inputs, which are other than assumptions, which have been used for the purposes of valuation. So what will the auditor do? Auditor will first of all check whether the details, the inputs which have been given to the actuary were complete or not. He will compare the data with the actual records of the company. Let's suppose if 400 employees data has been given, he can easily find out by looking at the total headcount of the company that 100 employees are missing. And because of which some adjustments may be required in the financial statements. Why? Because the valuation may have to be revised. And even if, let's suppose, all the employees have been captured, now the salaries, the compensation of the employees basis which this actuarial valuation would be carried out, maybe this is changed by the company. So now this becomes the responsibility of the auditor. But now we are talking about a data of 500 employees. So will it be possible for the auditor to test each and every item? No. In such a case, auditor will do a sample testing. So on the completeness, he will ensure all employees are covered. But on the data, when it is 500 employees, he will sample test that whether the details in relation to employees are correct in that data or not. Basis which he will ensure that yes, the inputs have been captured appropriately. Then comes the assumptions, for which he may require to have discussions with the actuary. He may require to meet the valuer. He may require to meet any of these parties. He may want to meet with them along with the management, or it may be a separate discussion. But generally, whenever these discussions, inquiries, or these procedures are carried out in relation to the work of the valuer, then the management consent is required. So after discussion with the management, auditor will start discussions for performing procedures or inquiries with all of these valuers. On the basis of which he needs to ensure that all the required inputs, all the required assumptions, as per the requirements of the accounting standards, as per the requirements of any technical standards have been captured. Now therein again, some of the valuation criteria, I'm just using valuation for an example, some of these criteria may be technical for the auditor. He may not be able to understand some of these items, or he may not be competent to directly audit some of these items. In such a case, auditor may consider involving his expert. And this is something similar to what we discussed yesterday. Auditor will consider involving his expert who will support the auditor in relation to this valuation which would have been carried out by the valuer. And using all of these procedures, auditor will then come to a conclusion whether the estimates have been recorded as per the requirements of accounting standards or not. And in case there are variations, in case he finds any misstatement, then he will have to make the adjustments he will have to get these adjustments made in the financial statements. And in case those are material, he may have some reporting implications, which again will require a discussion with the right. So this were about some of the procedures. So this involves both analytical procedures, substantive procedures, etc. And this is it that we had this in this auditing standard. Now, before I end my discussion on this accounting estimates, I'll just share some of the challenges and some of the practical problems that we generally get to see. Generally, whenever we start auditing most of these items, wherein a third party expert is involved, generally there is a thought that no audit procedure should be performed on that. Why? Because that is already valued or that is already considered by a third party expert. So that means something which is not computed by the management or wherein a third party has been involved by the management. Third party means other than the management or other than the company. Then there is generally an understanding that no audit procedure is required to be. Particularly if I talk about actuarial valuation, because this is common to all the companies. What the professionals generally think is that we have this certificate from the actuary, because this valuation which is provided by the actuary to the company is signed by the actuary. So it is considered to be actuarial valuation report, and because we believe that this is signed by the actuary, that's why our job is done, which is not the case. Which is absolutely wrong. And I'm sure you must have understood this by looking at this auditing standard. That even though a third party is involved, still it becomes the responsibility of the auditor to ensure that all the valuation criteria which should have been followed by the management as well as the actuary have been considered or have been followed or not. It is as important as auditing any other item. So we just cannot ignore by saying third party is involved and let's ignore this item. No. And that's why we also find this to be an area which is generally picked up by the reviewers when they review the financial statements or when they review the records of the practice units, that there were deficiencies in performing audit procedures in relation to accounting statements. Alright, so with this we are done with our discussion on this auditing standard. Now we'll move on to the next topic. If you have any query in relation to this, please let me know. We can have a discussion around that before we move further. Any questions from your side? Any questions from your side? Any questions, any doubts that you may have on this, please let me know. Then we'll move on to the next auditing standard. No questions? Yeah, so we move on to the next topic. Yeah, no questions? All clear on this? Yeah, this topic is important for your exam also. Okay, fine. So we move on to the next topic then. Next auditing standard, it is about evaluation of misstatements identified during the audit. Now for this standard, first of all, it becomes important to understand what is this misstatement. What is a misstatement? Misstatement is a difference between the amounts, classification, presentation or disclosure. Okay, so if you just look at this, it basically covers recognition, measurement, presentation and disclosure. Yeah, all of these things are covered which are coming from the accounting standards. A difference between these of a reported financial statement item and the amount, classification, presentation or disclosure that is required for the item to be in accordance with applicable financial reporting framework. So what does it mean? Let's take one example. Say in the financial statements, PP is recorded at rupees 1 crore. However, as per the accounting standard, it should have been recorded at 1.5 crore. So there is a difference in relation to the item which is appearing in the financial statement when we compare it with the requirements of accounting standard. Difference is of 50 lakhs. This 50 lakhs difference we can say is an error, which we very commonly understand as adjustment. In technical terms, for the purposes of audit, it is considered to be misstatement. Now this misstatement could be a mistake, could be an error, which could be unintentional, that's why we are calling this to be an error, or it could be intentional also, which may be in the nature of fraud, and because of which under recording or over recording of a particular financial item might have been done. So whenever we carry out any audit, during the course of this audit, various such items are observed by the auditor. Various such items are observed. Now, how will the auditor deal with all of those items? And in case there are misstatements, what should be the impact of those misstatements and what should be the reporting implications of all of those misstatements is something that we now need to discuss. When the auditor will be performing his audit procedures, it will not get impacted by the misstatement initially. That means initially when the auditor will plan his work, he will plan his work by looking at the risks which are attached, wherein he also considers some of the misstatements of the past years, of the previous years in relation to that particular client. Because for the current year, he doesn't know whether any misstatement will arise or not. But he must be knowing that some of the misstatements or many misstatements were there when he audited that entity last year, on the basis of which he will have to develop an expectation that in case many errors are observed when the audit is carried out, then he will develop an expectation that this year also many misstatements may arise. And in case in the past years he has found that the company's processes have been strong and their reporting requirements, their reporting procedures have been strong, and the management takes care of all the items properly, because of which misstatements are generally not found in the audit, then again he will have to just incorporate this aspect in terms of his audit procedures. So we are saying that the current year misstatements at the time of his planning is not impacting his procedure, but the past year trends are considered by him. Next aspect will be about the risk assessment, about the management controls, whether the controls of the management are strong or not. Basis that, auditor will evaluate that if the controls have remained strong, then chances of such type of errors, chances of such type of frauds are generally reduced. So that's why he will not expect some of these type of misstatements to arise. And in case controls have not been strong, he would expect more of these type of misstatements. Third, he will look at his materiality. Materiality is a threshold on the basis of which auditor carries out his audit procedures, on the basis of which auditor can also ignore some of the misstatements. Now this is very important for you to understand, because if we have to evaluate the impact of misstatements, materiality plays a prime role in that. For every entity, we understand a materiality threshold is required to be determined by the auditor. And this is determined when the auditor will be planning his work. There are various ways to do this. It may be on the basis of revenue, it may be on the basis of profit, it may be on the basis of total assets. It varies entity to entity, which is again judgmental. Once the auditor has determined the materiality, what does it imply? It implies that if there are any items which are crossing that threshold, then those items will become significant, which the auditor cannot ignore. And that's why those are called as material items. Material means significant. And materiality for the purposes of auditor is considered to be a quantitative thing. It is not a qualitative thing. Because he will have to set up a threshold, then the threshold has to be a quantitative thing. He will have to set up a number. Say he has ascertained a materiality of 1 crore. This has been set up. Now the auditor will understand that if there are any errors which are up to 1 crore during the course of his audit, then he would be fine with this. He can live with this. That doesn't mean that the auditor will not request the management to make the adjustments. Let's suppose he's checking revenue. He found an error of 10 lakhs. He's checking depreciation. He again found a difference of 20 lakhs. Then he's checking purchases. He found a difference of 5 lakhs. Then he's checking loans advances. He again found a difference of 30 lakhs. Then he's checking some expenses. Say he's looking at the inventory valuation, which is impacting the cost of goods sold. Therein again he found a difference of 20 lakhs. Now all of these differences he will consider on the basis of his materiality. This materiality may also require reascertainment. This may also have to be changed during the course of his audit, which the auditor will consider throughout his audit. But what we need to understand is that on the basis of materiality, if there are any errors up to that materiality threshold, auditor can ignore them. The auditor has found all of these adjustments and now auditor is requesting the management that please make these adjustments in the financial statement. See, there are so many errors which I could found on the basis of my audit, which actually you should have accounted for appropriately, but the management didn't do. And now management is also not ready to accept the request of the auditor. Management is saying these items are not significant. If you look at the financial statements of the company, if you look at the size of the numbers, these are not significant. And that's why management may not pass all of those accounting entries or may not adjust all of these amounts in the financial statements. These are called as unadjusted differences. Means the errors which have been found by the auditor during the course of his audit, but which have not been adjusted by the management in the financial statements of the reporting year. Now, in relation to all of those adjustments which have not been incorporated in the financial statements, auditor can accept all of them up to the threshold which he is having. Means up to the amount of materiality. In case these items cross the materiality, then the auditor cannot ignore it. Then the real problem arises in case those are unadjusted. Say for example, now auditor is looking at the fair valuation report. Now during the year, management got its PP fair value. As per the audit procedures which the auditor has performed, fair valuation should be say 20 crore. Management has considered that to be 25 crore. Okay. Now auditor has also performed reasonable procedures and also evaluated the procedures of the management. Now there is a difference of 5 crore. Auditor is requesting the management to pass this adjustment entry in the financial statements. Management is not ready to accept. In case the management accepts, passes this adjustment entry, it will not remain any error. So that will not be a consideration for the auditor, because that will be adjusted. So we can say it's a difference, but it's a difference which has been adjusted. So it will be adjusted difference. The problem arises when this is unadjusted and this is crossing the materiality threshold. In such a case, auditor will have to look at his reporting implications. If the management is not ready to do this, auditor may consider modification in his report. Why? Because this is material to the financial statements. Okay, yeah. So I'm just getting a query in between from Ricky. Let me just look at. Ricky is asking, why can't materiality is always in quantity? Say for example, entity failed and not agree to disclose certain necessary disclosures. It will materially impact an entity. Is it not a material misstatement? Definitely, Ricky. So when I say it's quantitative, I'm only talking about the quantitative threshold for recognition or measurement. Okay. I'm currently not talking about disclosures. Disclosures are equally important, and in terms of disclosures, some of the disclosures involve amount, some of the disclosures may not involve amount, but both of them are considered important. Okay, so if those will not be considered by the management, those will also have reporting implications. Okay, so when I say quantitative materiality, I am not ignoring that. That will very much form part of auditor's considerations. Okay. Okay, so now continuing on this. So whenever the auditor will come across this situation, auditor prepares a summary of adjusted differences and unadjusted differences. Two summaries are prepared, or you can say he prepares two details. He evaluates that. Summary of adjusted differences has already been considered by the management, but these differences should not have been encountered. These differences again reflects a problem in terms of the financial reporting. Why? Because it's not the auditor's duty to prepare the financial statements. Who has this responsibility? Management. And responsibility doesn't mean that they can just prepare anything and put it to the auditor for him to test. No. They need to ensure that everything is recorded appropriately in those financial statements as per the accounting standards. That means ideally they should have audited the financial statements on their own basis their internal procedures, and then it should have been produced to the auditor. And in case that is not done, then it is required to be made known to the management. So auditor will make this communication to the management. Auditor will discuss with the management that these were the adjusted differences during the course of the audit. And these adjusted differences will also be communicated to those charged with governance. When the auditor will have a discussion with those charged with governance with the audit committee, auditor will make a communication of those differences to them. Now comes the next part, which is very critical. It is about unadjusted differences. Now, during the course of his audit, two situations are possible. There are various unadjusted differences which the auditor will compile, he will add up, and he will check its impact, comparing with the materiality threshold. In case this is below materiality, then auditor may accept it. Auditor may not have any reporting implication in respect of those unadjusted differences. However, in such a case, auditor will make a communication to the management, to those charged with governance, that these have been the unadjusted differences during the reporting year. It will be important for the management to understand, those charged with governance to understand that these are the unrecorded items in the financial statements, but these have not been considered by the auditor because these were immaterial. When the auditor will obtain a representation letter from the management, management will have to include all of those unadjusted differences in the written representation letter. Management will have to bring out that during the year all of these adjustments were there which have not been recorded. Yeah, so management will have to accept it. So we are saying that it is not limited to just ignoring the immaterial items. In case these unadjusted differences are not recorded, management will have to put this in the written representation letter. And the other situation is wherein this is crossing the materiality threshold. In case that is crossing the materiality threshold, then the auditor may of course bring in the modification, wherein again the communication will be made to the management and those charged with governance, along with those modifications, if any, basis those unadjusted differences which are material. Plus, in such a case also, in the written representation letter, management will have to bring in those unadjusted differences. Yeah, clear? So this is how auditor needs to assess all the misstatements. He needs to just ensure that these are all captured at one place, which is generally a document called as summary of unadjusted differences, along with summary of adjusted differences, and which is then at the end considered by the auditor for making his conclusions while forming his view in relation to the financial statements. Okay, clear on this? Clear on this as regards the evaluation, as regards the reporting implications because of this which may arise, and as regards the communication requirements on the part of the auditor, and as regards the documentation which the auditor needs to obtain whenever auditor will have any type of misstatements, whether those are material or not material. Yeah, clear on this? So any questions from your side? Ambika is asking, am I reachable? Yes, you are reachable. You can definitely have a discussion on that query. I might have skipped your query, Ambika. We can have a discussion. If that is related to any other topic, we can discuss at the end of today's session. Okay, Uma has a query. Uma is asking how this material misstatement can be measured in the presentation of financial reporting framework. I think you want to understand about the presentation requirement. In case the presentation is inappropriate, then how that will be considered. So I'll take one example to discuss this. Let's suppose during the year, at the time of audit of financial statements, auditor comes across an item of say 5 crore rupees. Now this 5 crore should have been split into two parts, current and non-current. 2 crore should have gone to current, 3 crore should have gone to non-current. So this is how it should have been presented, on the basis of requirements of the accounting standards, on the basis of requirement of presentation of financial statement. However, what the auditor has found is that entire 5 crore has been taken to non-current. So instead of taking 2 to current, 3 to non-current, management has considered entire amount to non-current. This is a problem related to presentation. Now, is this presentation mandatory? Is it mandatory on the part of the management to ensure that the presentation is accurate, appropriate? Yes. So can the auditor ignore this presentation requirement? No. Again, what will he do? He will have to look at his materiality. Because this is an impact which is not going to the P&L, it cannot be ignored. Because it's only about a classification problem, he cannot ignore. Because this is as important as recognition or measurement. Okay. So this is how he will have to consider it, and this impact will also go to his summary of unadjusted differences in case the management doesn't pass an accounting entry. And auditor will have to evaluate this adjustment also when he will look at all the unadjusted differences. Fine. Monica is asking when the written representation has to be given. See, as regards the written representation, as we discussed, this has to be given by the management when the financial statements audit is concluded. So this is a document which passes from management to the auditor, and this is generally dated on the same date when the audit report is signed. Okay, Basically, if you just look at the things practically, the date when the financial statements are signed, that happens to be the same date when the audit report, when the MRL, this rep letter is signed by the management. So it is generally the same date. Okay. So I think Naveen has a query, in which chapter we can find this material for final syllabus. So I'll just request Karuna, if you're around. I think the students just want to know in which chapter they can find this document, this topic, this essay 450. I'll just clarify on this point. I think she is not around, so no problem. So whenever we have her with us, we'll have a discussion on this. Okay, I'll just let you know accordingly as to where in the chapter you can find this. Then the next query is coming from Nagasai. He's asking, in case of unadjusted errors, what is the audit procedure? This is what we have discussed. In case of unadjusted errors, the audit procedure is dependent on two things. In case that is immaterial, then it may be ignored by the auditor, but auditor will make a communication to management, those charged with governance, and also take a report. In case these are material, then the auditor will have to evaluate his reporting requirement. Means whether he should go in for modification on the basis of those adjustments or not. Okay. Then the next query is coming from Uma. Uma is asking, if one of the item of P&L is materially misstated, say sales, can the whole of the financial statements is said to be materially misstated? So I think, Uma, for some time you need to wait to have a detailed discussion around it, because when you will be covering the requirements related to audit report, there will be a detailed discussion on this. Quickly, for the purposes of your understanding, I'll just tell you that whenever these material misstatements are found, I'm talking about material misstatements, okay? Then the auditor needs to assess whether its impact is pervasive or not. In case it is pervasive, then we will say that this is impacting the entire financial statements. In case it is not pervasive, then this is considered to be only impacting that particular line item and not the financial statements as a whole. In your example, sales is one area which can be a big chunk of the P&L, but depending on the impact which would be there in the sales, we need to ascertain whether its impact to be going to be pervasive, which will have a bearing on the entire financial statements as a whole. If we say no, if we say, let's suppose sales was say 200 crore and there's a difference of 1 crore. So its impact is there, but this impact is limited to this particular line item. It is not extending to financial statement as a whole, or it is not something which is significant covering major part of financial statements. However, if we say there's a big gap in this, there's a big gap which is say amounting to 20 crores, then I would consider that it's a very, very big gap and which may have an impact on this entire P&L as a whole instead of just looking at this particular line item. Okay, so Kapil is asking, is there any particular matter on which MRL should be obtained compulsorily by the auditor? Yes, and that matter is financial reporting. On the financial reporting as a whole, auditor needs to obtain written representation from the management. Now, financial reporting may cover various things. Yeah, if you have to remember that one item, then I would say it's the financial reporting. Or in simple terms, preparation and presentation of financial statements, which will include the internal controls in relation to that preparation and presentation of financial statements. Ambika has a query. Ambika is saying, in case of audit of chemical industry, auditor audits the financial statements which shows true. I think your query is incomplete. Huh? Put down your complete query. So I didn't understand. So if you are saying, sorry, very difficult to find out. Kunal is asking, what if estimate made by the auditor and management is different, and estimate made by the management is correct, opinion of auditor is not correct, auditor issues modified opinion, what is the remedy left by the management? This is interesting. This is interesting. First of all, this will not happen. This will not happen. There can always be a difference of opinion, which is true, and this is not limited to estimate. Actually, this can apply to any item. Whenever auditor and management will have a difference of opinion, practically it's not an easy situation to handle, because practically then the two parties are moving in a different direction, okay, which is not really something which can be appreciated, because these two parties should work as a team. Audit is something which will involve involvement of the auditor as well as the management. They need to work together. And in case there are any differences between these two, then this entire audit procedure may get impacted. Now, talking about this particular situation, let's suppose if there is any difference of opinion, then in such a case, management may say that my assessment is correct, auditor may say his assessment is correct. Now, who is going to be correct or who is going to be incorrect is very difficult, because it is expected that management should have performed reasonable procedures, should have considered all the requirements of financial reporting framework, which is also mandatory on the part of the auditor. So, auditor is also expected to perform his audit procedures with reasonable accuracy. Auditor is also required to follow the same financial reporting framework. However, there could be differences in their judgment, which is possible. Because of those differences, when these type of problems will arise, both of them will talk together, both of them will talk to each other, both of them will consult on these matters with third parties, basis which they will also get a perspective as to who may be going wrong or who may be going in a different direction as compared to what it should have been. But still, if we believe that the auditor has just went ahead and qualified this, then the resolution which is available to the management will be to explain that. Okay, explain that in the notes to accounts, which is anyways done by the management. And there is also a document, okay, which is also about the director's report, in which the management is required to give the explanations around the qualifications which have been made by the auditor. And all of these things are required to be discussed by the management there. Okay, so I would say this is the only remedy available. Vasudha is asking, sir, error in valuation of inventory is materially affecting the financial statements. So we apply SA 450 or SA 540. So when you say SA 540, you are talking about accounting estimates. Okay, as valuation of inventory is also a part of accounting estimates. Again, don't mix up this thing, it's very simple. First of all, you will apply SA 540, basis which auditor will perform his procedures. Okay. Once that is applied, only then auditor will come across that adjustment, on the basis of which auditor will consider that adjustment, or you can say auditor will apply SA 450. So I can also make it sequential for your understanding, that till the time audit procedure is not performed, can he get any misstatement? No. So what will be done? First of all, audit procedure will be done, which will result in any misstatement. Only then the auditor will evaluate the misstatement. Yeah, but we cannot say that these two will not be applied, either of them will be applied. Both of them are required to be applied. Understood? Komal is asking, in case of material misstatements, given sale example, okay, query done by me, there is a concept of performance materiality. Yes, that's correct. There is a concept of performance materiality. I'm sure in the materiality you must have understood about all of those things. Huh? Yeah, you are absolutely right in that. I think Ambika, you have been sending your query and I have been receiving your query. But seems to be a problem at your end. You need to check on please, because your query is incomplete. Again, the part query has been received. I'll just read out for your reference. In case of audit of chemical industry, auditor audits financial statement which shows true, full stop. Okay, so this is the only part which I have received. Yeah, I think you need to go beyond this. All right. So I don't think I have any further queries. We can now move on to our discussion related to next topic about risk assessment and internal control. Yeah, all right. So moving on to the next item, risk assessment and internal control. Considered to be very important topic for all of you. I'm sure you must have already covered this topic at inter level, at your previous level also, because most of the requirements related to risk assessment are similar. In relation to audit, these days particularly, this is one area which is focused upon by the auditor. These days, concept which is called as risk-based audit is followed. I'll just talk about audit briefly with you, and I think with that you will easily be able to understand why this may be important or why this may be critical. I hope that by now you all must be knowing what is audit and what all procedures are required to be covered there. And you all understand the limitations of audit. In relation to audit, there is a limitation. In relation to audit, there is a limitation. And because of this limitation, auditor's reporting is also limited. Auditor knows that he cannot audit each and everything. Let's think of a company which are large. Companies which are large. Let's talk about companies like Tata Motors. Let's talk about companies like Reliance. They have lakhs of transactions throughout a month. In fact, they have thousands of transactions in a day. And the transactions are, I just cannot have any count on the number of transactions. And the numbers are all big if you look at their financial statements. And let's suppose if the auditor wants to audit the financial statements of that entity, even if auditor will audit throughout the year, which actually happens in case of large entities, audit team sits at the client place almost throughout the year. It is practically not possible for the auditor to test, to check, to verify each and every item. Practically it's impossible. So that means auditor has to select some areas. He has to be selective in his approach. And that's why it is very, very important on the part of the auditor to now choose a technique basis which he will get into this selective testing. And that is where the risk assessment comes into the picture. Risk assessment in simple terms means that auditor needs to focus more on the areas which have significant risk and focus less on the areas on which risk is not so significant. So we are talking about a large company and we are saying auditor has a limited time. Now this limited time should be used by the auditor by focusing his attention on those areas which are significant to him, which are having more risk, as compared to some of the items which may not be so risky. If we talk about revenue recognition, revenue is one area for which the companies generally exist today, isn't it? Because only when they will have operations, only when they will have sales, they will get profits, which is actually the end objective of most of the companies. And the companies will generally be inclined to show more and more revenues. And that's why revenue will be one area which will always be significant for each and every type of the entity. Now, as compared to that, let's think of another item which is recorded in the financial statements, say printing and stationery expense. So in the financial statements, we are saying two items have been recorded, revenue and printing and stationery expense. Now, do you think that printing and stationery expense is as important as revenue? Let's suppose auditor spends equal time on revenue and printing and stationery. Do you think it will be worthwhile? No. Why? Because we are not saying that printing and stationery is one item which can be ignored by him. No, we are not saying let's ignore that completely. We are saying perform procedures on that. There could be errors in printing and stationery expense also. But still, the extent of procedures which the auditor will consider on revenue cannot be the same which he will consider on printing and stationery. This will vary significantly. And this is something which is dependent on the assessment of what is significant and what is non-significant. That means he needs to divide his entire financial statements audit into two parts, significant and not so significant. And this is somewhat similar to which you also do, which ideally you should not do. Okay, you can relate to this. Whenever you prepare for the exams, you break your subject into two parts, important topics and not so important topics. In fact, you say these are not important, so let's ignore all of them. It's not the right thing, but I'm just trying to link this with that. And the same thing auditor is also required to do. This assessment requires risk assessment on the part of the auditor. Okay? So let's talk about this risk assessment as to what is required to be done in case of risk assessment and how it will help the auditor. Now, talking about the audit risk. Audit risk means the risk that the auditor gives an inappropriate audit opinion when the financial statements are materially misstated. So we understand that there are limitations in respect of any audit, and that's why even though audit is performed, there can be a risk, and the risk will be that financial statements are misstated or those were misstated, but the auditor could not find that misstatement, and that's why his opinion was inappropriate. In case the financial statements were misstated, he should not have given a true and fair view, but he could not capture it, and that's why he went ahead with true and fair view, and it led to inappropriate opinion. Now, in relation to audit risk, we can have its bifurcation into three parts: inherent risk, control risk, and the detection risk. Now, what is this inherent risk? Susceptibility of an item of the financial statement. Susceptibility of an item of financial statements that could be materially misstated before consideration of any related control. Means there could be an item in the financial statements which may be materially misstated. Now there is a risk. When does it become inherent risk? Say for example, if we talk about FMCG, so I'm talking about industry. In this industry, the nature of inventory will be what? most of the inventory will be perishable. Correct? Most of the inventory in such a case will be perishable. So there is always a risk which is attached to the inventory, that whether the inventory which has been recorded in the financial statements is really worthwhile or not. Means, is that really something which will have some economic benefits? Means, in relation to its valuation. This will generally be a risk area. This is something which is inherent in this industry. So if there is any company which is dealing into FMCG, so irrespective of what all things they may be doing, this risk will always remain attached to the inventory item. Let's talk about real estate. In case of a real estate industry, estimates are involved. You all understand how the revenue recognition happens. Estimates are involved in relation to the costs which are required to be recorded by them. In relation to those estimates, we understand that the estimates are never accurate. They cannot be precise. They are all of approximation. And whenever auditor will look at the financial statements of any such company, what will happen? This risk will always be existing over there. This is more of an inherent risk which exists in this industry. So any company which will be dealing into such type of business will have to live with that type of risk. Yeah? Clear? Moving on to the next type of risk, which is called as control risk. Now what is this risk? Risk that a material misstatement could occur in an item of financial statements which will not be prevented or detected or corrected on a timely basis by the entity's internal control. Now we know that the management will have processes, they will have systems to address various type of risks. But still, there could be some type of risks which may not get captured by the controls. Or even if controls are there, they may not be operating effectively, and that's why despite having that control, there could be a misstatement in the financial statements. Or maybe some of the controls are missing altogether, and because of which material misstatements may exist in the financial statements. So that means controls of the management or the control system of the management is unable to prevent any misstatement. This type of risk is called as control risk. Third, this is called as detection risk. Now what is a detection risk? Risk that the procedures performed by the auditor to reduce the audit risk to an acceptably low level will not detect a misstatement that exists, and that could be material either individually or when aggregated. Now this is a type of risk which is related to the audit procedures. Whenever auditor will perform his work, what is the objective? His objective will always be to reduce his audit risk to a level wherein he will be assured that yes, risk has come down to a very low level, and that's why all the procedures that he would have performed would have resulted in financial statements being presented in a fair manner. However, some of his procedures may carry a limitation. We all understand that he has a limitation in terms of carrying out the procedures. Maybe in sales, wherein lakhs of transactions exist during the year, he may have picked up a sample of 150 transactions. when he will pick up a sample of 150 transactions, then he cannot be sure that if any error will exist in the company in terms of revenue, then that error will only be existing in the 150 transactions which he has selected. Those errors may also exist in those transactions which he has not captured, which he has not considered. So this is possible. But does it mean that he now starts testing each and every transaction? No, that's not a requirement. And that is something again which is not possible on his part to do. Yeah. So these risks will always remain. Yeah. So all of these risks on a combined basis are called as audit risk. So we are talking about inherent risk, control risk, and detection risk. Inherent risk and the control risk taken together are also called as risk of material misstatement in relation to the financial statements of the company. And on the top of it, when we add detection risk, it becomes audit risk. And the objective of the auditor is always to bring his audit risk to a low level or to a level which can be accepted by the auditor before making a conclusion and before expressing his opinion on the financial statements. Okay, clear? Let me just quickly look at some of your queries around it. Just give me 1 minute. So Bhanushri is asking, can we have an example of control risk so as to have clear understanding in practical scenario? Sure. Uma, I have already answered your query. Now moving on to the control risk. Let us suppose in relation to PPE. In relation to PPE, let's suppose management established internal control system. Okay. Basis which PPE are procured, that means fixed assets are purchased, and those are recorded in the financial statements also. Now sometimes it may happen that some of the controls may be in relation to physical verification of fixed assets, may be missing. So management has purchased machinery during the year, and machinery is also recorded in the financial statements. Now there should also be a control to ensure that the machinery stays with the company. It's not stolen. Let's suppose that control is missing. Let's suppose that control is there, but that control was not effective. Because of which, what will happen? Physically, that machine is now non-existing. This machine is gone. But will this machine continue to appear in the financial statement? Yes, till the time it is detected. But the control is not in place, so that's why we don't know that this problem has arisen, or maybe till the time any audit procedure is not performed or any procedure is not performed, will not know that this problem exists. Now, can it lead to the misstatement in the financial statements? Yes. And do we say that the management had a control system in place? Yes. But despite having the control system, some of the control systems were not working effectively, or maybe some of the controls were missing, and that could lead, and that has actually led to this misstatement. Yeah, clear? Clear, Bhanushri, on this error or this misstatement which is possible? Now moving on to internal control system. So let us talk about internal control system as regards its nature, scope, objective, and its structure. Because this is considered to be a very important area. These days, when the auditor starts audit, at the time of his planning, couple of things are required, which are very critical. One is the risk assessment and second is the evaluation of control. Because these two go hand in hand, actually they exist for each other. If the risks are there, then the control should also be present. And the control will always be there because the risks may exist. So let us now understand what do we mean by this internal control. Before I talk about this definition of internal control, let me just understand from all of you. Okay, can you please give me some examples of internal control as per your understanding? All of you, you have not been answering the questions because I have not been asking you. So this is an important point for all of you. And I'm sure you must be knowing about it. So can you give me some examples of internal control quickly? Yes. I'm just waiting for some examples of internal control. Maybe you can just briefly give me the internal control. You don't need to elaborate all of those points. I'm just waiting for a response now. Internal control. Any example? Quickly, please. Yes, I'm just waiting for a response. It may be simple, it may be complex, it doesn't matter. Any example? Quickly, huh? I'm just hoping that you are typing and sending it quickly. I'm just waiting. Okay, great. Nagasai has given one example, that is authorization. Okay. What about others? Any other example of internal control? Yogesh is saying cash book. By cash book, what do you mean? If you can just briefly cover that part also. Naveen is saying attendance system of employees. Very good. Manjunath is saying internal check. Internal check in relation to what? Ricky is saying like in shopping malls, billing is done at the different place and delivery is done at the different place. Sure. Very good. Seema is saying rotation of staff, and I think we also discussed about it. Supreet is saying segregation of duties. Very good. Akash is saying it's a two-step check, like for cash and inventory. Okay. Utya Kumar is saying segregation of duties. Anushri is also saying segregation of duties. Kapil is saying it's as simple as like login ID. Okay, that means restricted use. Mukta is saying it's like bank reconciliation statement. Alright. Then I think Ricky has talked about the shopping mall, it's the same one. Shreya is saying it's like a bank reconciliation. Great. Great. So that shows that you have this complete understanding about the internal control, and that makes my job very easy for all of you to, for this to be discussed and explained. Okay, I am also receiving some more responses. I'll just quickly read out, but I may not be able to read all. Uma is saying passing and verifying bills before making the payments. Vasudha is saying accounting, recording, posting financial statements. Komal is saying changing job positions. Gunjan is saying it's like physical surveillance, which is through CCTVs. Kunal is saying physical verification. Jason is also saying physical verification. Okay, great. Then I have received some more responses, but sorry, I have not been able to read out all of them. I may not be able to read continue. Ambika, Shikha is saying budgetary control. Gaurav, Monica, they have also responded. Harsh, Komal, they have also given some more. I think these are good enough for me. These are good enough for me, huh? So I think we can just stop over here. Shashi is also sharing the example. Great. Now coming back to the internal control. What is an internal control? For any management will have a control in place. Why that control will exist? So that the risk will not have any impact to the company. For example, like we just discussed about this item, that whenever any bill or invoice will be received, then there should be a check that along with that invoice, goods should also be received. Who will check this? This check will be done by the guard who is doing the gate entry. So whenever any goods will be received inside the premises of the company, there should be an invoice. And in such a case, what should he do? On the invoice, he should just make a mark that yes, it's been tested. The entry has been tested. Or yes, the goods are in place. Otherwise, what can be a problem? Otherwise, it may happen that the invoice has been received, because of which entity may become liable to make the payment, but actually no goods have been received. Will that have an impact to the company? Of course, yes. Company will have to pay for the liabilities which actually don't exist, or against which company has actually not received any goods or services. Now, do you think it is possible for anybody to track on a day-to-day basis? For the management, it's not possible. For the board of directors, it's not possible. Do you think the directors can sit on the gate of the company and just keep tracking it on a daily basis? No, it's not possible for them. Do you think the CEO of the company will do this activity? Again, it's not possible. And similar to this type of check or similar to this type of control, there could be thousands of controls which may be required by the company, so that there is no impact of any of these type of risks. So for this purpose, what will the company do? Company understands that they have limited people at the top management. And even those limited people do not have this task of looking into all of these controls. So what do they need to do? They need to come up with a process. They need to come up with a system which needs to be established in the organization, basis which all these things are getting controlled, or all of these things are controlled. That system is called as internal control system. So now let's read the meaning of internal control. It's a process or set of processes designed to facilitate and support the achievement of business objectives. Any system of internal control is based on consideration of significant risks in operations, in compliance, in financial reporting. So the objective could be any, and the risk can also be any. But of course, the most important point that will have to be considered by the management is that all the significant risks are always captured. Ideally, when the management works on the internal control system, they don't limit themselves to significant risk. They cover all the risks, but at least the significant risk will be captured. So moving further, what do they include and what will they have as their scope? Facilitate the effectiveness and efficiency of operations. Will that increase? Of course, efficiency will improve. Yes. Will there be any effectiveness in relation to these internal controls? Of course, yes. They help ensure reliability of internal and external financial reporting. Is that going to be correct? Yes. Because let's suppose if the items are now recorded correctly in the financial statements, on the basis of their actual existence, only then we can say financial reporting is reliable. Let's say a company has received a machine during the year, which was also verified when it was entered in the company's premises, when it actually entered the company's premises, but after 1 month, because there were no checks in place, so that's why somebody has stolen the machine. And now at the year end, this machine is continuing to appearing in the financial statements. Will that be appropriate? No. Do you think in that case financial statements will be correct? No. Those are not reliable because the item which is recorded in the financial statement, that is missing. So how can that be improved? By having a system of internal control. Internal control also supports in laws and regulations. How will that happen? Similar to any of these type of operational requirements, entities will also have systems to ensure that they stay compliant with the laws. They stay compliant with any regulation which may be applicable to the entity. And how can that be done? Let's suppose company is into production of movies. Okay, so company is in the entertainment industry. So company has the business of production of movies. Now company has started producing a movie. Okay, this direction, all of this is going on. But after this production has started, let's suppose 2 months later, company receives a notice of the regulator that you need to obtain a license. Whenever you want to carry out this activity, you have not taken this license, you have started this activity, let's pay a penalty. And this penalty is very heavy, that is very significant. Now what will happen? It will impact the financial statements. It will impact the systems of the company. For this, what should the company do? Company should again bring in a control. Company should bring in a compliance officer or an employee who will ensure that all the regulations which may become applicable because of any type of transaction is fully complied by. Now what will that become? That will again become a type of internal control. Helps safeguarding the assets. This is something we have discussed. Yeah. So what are the objectives? I think these are fairly clear to us, but still let's quickly look at some of them. Transactions are executed through general and specific management authorization. All the transactions are properly recorded. Assets are safeguarded from unauthorized access. Use. Assets are verified at reasonable intervals. Appropriate action is taken whenever there are any discrepancies. Basically, we can just tell this in simple terms that all the transactions are properly recorded. All the transactions which have been recorded are real. All the transactions have been recorded at correct amount. All the transactions have been recorded in a timely manner. Their posting in the financial state, in the books of accounts was done accurately. All the items have been properly presented as per the requirements of the financial reporting framework. The disclosures have been appropriately given. Yeah. So it's all about ensuring that the financial reporting is appropriate. Now there could be some limitations of the internal control. We understand the benefits. There is no doubt there are benefits which are attached to the internal controls, but definitely it will also have some limitations. Let's try to understand about the limitations. The possibility of circumvention of internal controls through collusion with employees or with parties outside the entity. You remember control risk we discussed? In the control risk we discussed that there was a control, but the control was not operating effectively. So the same thing may happen in case of this control system. Management has set up a control system and management is ensuring that this control system should be very robust. This should be very strong. But still, there are people in the organization who are not following the control policies, who are not following with the systems. So in such a case, will the control have any benefit which it should have given to the which should have given to the entity? No. Possibility is there that a person who is responsible for exercising a control could abuse his responsibility, which is also called as management override of control. So I'll discuss two examples with you now and we'll understand what are the limitations through this. Say during the year, some of the assets of the company have been stolen. There was a control in relation to safeguarding of the assets. What was the control? That the assets are kept at a place and outside that place there is a security guard who will ensure that whenever any asset is moved, there is a proper entry in the gate outward register and there should also be a proper authorization by the person who wants to move that asset from that particular location to some other location. So let's suppose this employee has wrong intent, or the security guard along with the employee or along with another person wants to steal this. So what will he do? He will just bypass this control. He will ignore, and because of which this control will fail. Possible? Next, there could be a control which the management might have established. I am talking about the management now. That whenever there is any transaction, it should be recorded by the executives. Means there is a level of the entity, executives, means transaction should be recorded by the executives, and it should be approved by senior manager and above. Means up to the level of manager, transactions can be recorded, and it should be approved by senior manager and above when it is required to be recorded in the books of accounts. Okay. It's a two-way check. One is recording, other one is checking. Now management has an authority wherein the CFO of the company can also pass the accounting entry, can also authorize that accounting entry. So now let's suppose what the CFO has done is, CFO came to the premises of the company on a holiday, on Sunday, when the office remains closed. He passed an accounting entry and he also approved that accounting entry. Was he in a position to do this? Yes, because he is having this management role. So basically he is overriding the internal control because of his position. In such a case, will those controls be of any benefit? No, that control will fail. These are some of the limitations which are attached to the internal controls, which are always required to be considered by the auditor. Alright? So I think Shatrudhan has a point. He's saying, like in e-commerce company, many items go missing during the process of delivery from store to customers, and the reason being there's a huge amount, and because of this reason there's a huge amount which is charged in the P&L. Yes, this is possible. This is possible. Okay, Monica is saying I lost this example of complying with laws. Yeah, sure, no problem. So maybe at the end we can discuss. Okay. So now moving on to the components of the internal control. So what are these components of internal control? Let's have a discussion around all of those components. A system of internal control to be considered adequate should include all the 5 components. Control environment, entities, risk assessment process, control activities, information systems and communication, monitoring of control. So let us discuss all of them one by one. One thing which we need to understand before we get into this understanding of controls is that internal control is not something which is a transaction. Internal control is not something which is only a check. It's basically a system of the organization as a whole. It's about having a process in the organization which will cover entire organization, which will cover all the processes of the organization, which will cover all the people in the organization. Okay, because generally when you will look at all of these components, you will find some difficulty in their understanding. I'm sure you will be able to relate to this point. And why will that happen? That will happen when you will associate internal control to only a single transaction, to only a single check. You need to look at it as a process which is pervasive, which is existing for entire company, which not only covers still employees at the low level, which also covers employee at medium level, employees at higher level. It means for the organization as a whole. The first component talks about the control environment. Control environment in relation to internal control system talks about some components or talks about some elements which is about integrity and ethical values. We are talking about control as a check, that the practices are good so that the things are running in a fair manner. How is that possible? You remember we discussed about practice unit yesterday? You remember we discussed about SQC1 yesterday? Wherein we discussed about having policies and procedures in place. What was it all about? That was all about following good practices. And how is that possible? Can we just keep bringing some checks for each and every transaction, and do you think because of that control system can remain effective? Not possible. It's not possible till the time people built in a culture within themselves, because of which all of these controls will become effective. That is all about that is all about following integrity principles. That is all about having the ethical values. So for a control environment, it is important in relation to all the people in the organization to have these values, and this should be forming part of the organizational culture. Commitment to competence. There should be a commitment on the part of the employee, wherein they should be committed towards their competence. And this commitment should come on the part of their employees from within. Let's say, for example, if we tell an employee that you need to carry out, say, 20 jobs in a day, he may be competent to do this, but he may not be inclined. He may not want to do this. Why? Because he may think that why do I need to do this? It's only a job which I need to do. I'll just cover the jobs which are possible in a day and I'll just leave it. Whatever is incomplete. Other one is an employee who is motivated, who is actually committed to his work. And because of his commitment, he will not only complete 20 jobs, he may in fact complete those 20 jobs within half a day, and he may be ready to complete on or work on some more jobs also. And how is that possible? That is again possible by having that culture in place. And this requires participation by those charged with governance. The importance of responsibilities is something which should be recognized in the code of conduct, in the policies and procedures, which should not only be limited to the low level or the medium level, which should actually flow from the top. Yeah? Organizational structure should be such that all of these things become inherent in their system. There should be an assignment of authority and responsibility. Why is that important? Because let's suppose if you give somebody an authority, but he doesn't have any responsibility, will that be of any benefit? No. And let's suppose if we assign any responsibility to a person for which he may require some level of authority, but we have not given him that authority, so will that be effective? No. That will not become effective. Let's say if we talk about safeguarding of assets, for which there is a security guard. Now, guard has the responsibility that he will not let anybody move the assets from this location to another location. Now, guard needs to have an authority. Let's suppose there is a senior management employee who has come and he is just taking away that asset, and guard is saying, no, I am not authorized to ask this employee. So, will that control remain effective or there? No. So, that's why that guard needs to have that authority along with the responsibility. That will be important. Otherwise, he will not be able to carry out his work properly. The policies of the organization should be established in such a way that all of these things are accordingly taken care of. Yeah. Moving on to the next component, this is about entity's risk assessment process. Entity's risk assessment process includes how the management identifies risks which are relevant to preparation of the financial statement. After evaluation of all the requirements of financial reporting framework, which covers everything in that respect. Let's talk about some of those risks. Risks can arise or change due to some of these circumstances. There could be a change in the operating environment. Means changes in the regulatory or operating environment can result in changes in the competitive pressures. New personnel may have a different focus or understanding of internal control. He may not really know about the internal control. Maybe he's a new hire, he doesn't know much. There's a risk which is involved there. Maybe the information system of the organization has been changed, which has actually resulted in a situation that most of the people don't understand the information system. Now, these are some of the situations which may lead to a risk or which may lead to more risk as compared to the risk which may be existing. Now, in relation to any organization, whenever they will set up an internal control system, what becomes important? Important thing is to assess all of these risks. Because when they assess all of these risks, only then they will be able to identify the control against each and every risk. Next component which talks about the control activities. Now these may be relevant to the auditor and they may be categorized as the policies and procedures in relation to the performance reviews. Now what can be a control mechanism? Control mechanism may be in relation to the review of the performance against a particular benchmark in relation to any employee or in relation to any of the operations of the entity. Because when we have this benchmark in place, then we'll also be able to control that by comparing all of those items or by comparing all of those processes, by comparing all of those activities against the standard practices or against the good practices. Information systems should be such we should only support all of these processes in relation to establishment of internal control. There can also be physical controls which can be put in place. For example, physical securities of the assets. These become equally important in relation to any type of internal control system. Segregation of duties, we discussed. Information system and the communication. This is again a very, very important component for any organization. Why? Because any organization these days will have some element of information system as part of their processes. These days, when it comes to recording of the books of accounts, when it comes to posting of the accounting entries, how is that done? That is done through a computer system. That is done on an accounting package. It may be as small as Tally or it may be as sophisticated as say Oracle or SAP or maybe some other customized ERP package of the management. But all of them are important. And for all of those systems, again, what becomes important is to evaluate the risks which are attached to them and to make the people understand about all of those systems. Because if the people will not understand all of those systems, if the people will not have an understanding as to how those systems are working, they may not be able to operate all of those systems in an effective manner. Monitoring of controls. An important responsibility of the management is to establish and maintain internal control on an ongoing basis, which is possible when there is monitoring. Let's suppose control system has been put in place. Let's suppose when the control system was put in place, a thorough study was carried out of all the risks which could exist, and everything was covered when the control system was brought in. Let's suppose 3 years later, company has started some new operations, or company has started into entering different type of transactions. Now, because of these new activities, can the company become subject to some different type of risks? Yes. And because of all of these different type of risks, what may happen? Because all of these different types of risks, some of the risks which were identified earlier and some of the controls which were put in place earlier, now those controls may not be able to address this new type of risks. So what should be done by the management? Management should keep looking at all of these processes. It's about their evaluation on an ongoing basis. So it's not something which is a one-time activity. It needs to be monitored carefully. And it's not something which is only about the new processes or the new controls. Even in respect of existing controls, management need to monitor it, whether the people are actually following all of these systems or not. Because it is possible that after a time, maybe initially people were following all of these systems, but after a time they stop following some of these systems, which may again have an impact on the procedures, which may again have an impact on the way the amounts are recorded in the financial statements. Okay, clear? Clear on this, all of you? This was all about some of the components of the internal control system. Now comes the next part, that is about review of internal systems. Review of internal controls. Now, in relation to review of internal control system, what will be the requirement on the part of the auditor? Now the auditor needs to get into the same system of the management. So far we discussed that management will set up a risk assessment process, management will set up a internal control system. Now comes the task of the auditor. Now he needs to get into this process. For this, the first and foremost requirement for the auditor is to get an understanding. Auditor needs to understand all the processes of the organization, which is also about understanding the business, understanding the economic environment, understanding the industry in which the entity operates, understanding their organizational structure. Once this understanding is obtained, then the auditor will also be able to evaluate whether the management identified all the risks or not. Or is it that there could have been some more risks which have not been identified by the management? And if there are certain risks which have not been identified by the management, what will happen? Controls will not be in place in respect of those risks. So will the control system remain effective? No. Now, at times it is also possible that in relation to a particular risk, two controls are there. And same control may be able to handle different types of risks. All of these things need to be evaluated by the auditor. And how will that happen? So auditor needs to have a discussion with various process owners. Auditor will have to first of all identify all the significant processes which exist in our organization. For example, revenue is a process. For example, payroll will be one process. For example, capitalization, which is about fixed assets, will be one process. Procurement is one process. Accrual of expenses is one process. Auditor needs to first of all identify all of these significant processes. Once he'll identify all of these significant processes, then he will start having discussions with the process owners. Means the relevant personnel in the organization who have been handling all of these processes. On the basis of discussion with those organizational with those relevant persons, auditor will have an understanding through which he will also understand that in respect of each and every process, what are the risks which have been established, or what are the risks which have been identified, which have been established in the risk assessment process. Along with this, auditor will also identify the risks, which we will discuss with the process owner. Once the risks have been identified, once the risks have been assessed, then the auditor would understand what all controls are existing, which the management has established. Now, this is very important. When the auditor will go and audit, auditor does not need to bring in his all controls. No. Auditor will have to look at the controls of the management. So generally, there is a misunderstanding that when it comes to a control, that means it's more of an audit procedure. Management doesn't need to do anything. No, that's incorrect. And that is what we have discussed. That control means controls of the management only. Now, as an auditor, what will he check? He will check whether the management has identified control in respect of each and every risk or not. Let's suppose after his discussion, he has understood. He has only understood that yes, risks have been assessed and the controls are also existing. But this is only an understanding. This was only a verbal discussion. Let's suppose auditor is sitting with the marketing head, sales head, who is explaining that in our company, the risk assessment or this internal control system is very robust. And he has explained all of those things. He has also provided relevant documentation, the SOPs or the flow charts for the auditor to understand how these controls have been established. The next step on the part of the auditor will be to do a walkthrough. Now, what is this walkthrough? Walkthrough means auditor will walk through a particular transaction, which the management or the process owner would have explained to the auditor. You can also relate to this. Let's suppose when you start understanding a concept, you keep asking us, sir, can you give an example for this? Because when we give an example, it becomes easier for you to understand, isn't it? Similarly, auditor will also talk about the same thing. Auditor will say that so far I have discussed everything with you, that is fine. But let me just take through this entire process in a practical manner by taking one example or by taking one sample. So he'll just run through this entire process. He will run through this entire risk assessment and the control which is put in place by looking at one sample. That is called as walkthrough. On the basis of his walkthrough, he will now be assured that yes, controls are in place. Then the next step on the part of the auditor will be to get into the control testing, which comes later. But the first point will be to look into the controls, whether those are in place or not. Okay. Moving further, some of the methods which may be considered in relation to the recording. One is questionnaire. Let's understand about questionnaire. Because of the widespread experience auditors possess about the business operations in general and the knowledge about the appropriate control, most of the auditing firms have developed their own standardized internal control questionnaire on a generally applicable basis. Let's see how these are used. So we are again in the same process wherein the auditor wants to understand about the organization. Auditor wants to understand about the processes. Auditor wants to understand about the controls. So one, we said it's a discussion with the process owner. There is one method which is called as questionnaire. Auditor generally prepares a questionnaire in respect of each and every process, and that questionnaire is given to the relevant process owner or to the management. The management is then required to answer all those questions which are given in the questionnaire. The questionnaire is what? Questionnaire contains various questions, which is on the basis of the understanding of the process which the auditor may have, which the auditor may already be having on the basis of his prior experience. The questionnaire may also have some points which may not be applicable to the company. Why? Because auditor has considered all of these points in general. And therein, auditor will need to get into an answer to all of these questions, which will be provided by the management, by the relevant team of the management. And once they will answer all of those questions in the questionnaire, on the basis of those answers in the questionnaire, auditor will develop his understanding. Auditor will do his assessment about the risks as well as about the internal controls. This questionnaire is generally sent by the auditor to the relevant person, and the relevant personnel is required to fill in the questionnaire or to provide his answers and then give to the auditor. And after a point of time, auditor can just come and sit with the relevant person to have further discussion, or at times auditor can also take this questionnaire along and just keep asking the questions and just keep recording all of these things. Okay. So one way is questionnaire. Then there is another way which is called as checklist. I'm sure you must be familiar with the checklist. Checklist, you can say it's a listing of the items. It's a listing of various activities. Again, in relation to a process which the auditor would develop. And the auditor will give the management, and management need to answer this. This is generally answered by saying yes, no, or not applicable. Unlike questionnaire, wherein some explanation is also provided. Generally, it talks about some of the questions which are answered in yes, no, or not applicable. On the basis of checklist, auditor can gather information and then can do his further evaluation. Let's see some of the questions which may be there in the checklist. Have you checked that the cashier is not responsible for opening the incoming mails, does not authorize any of the ledgers, does not authorize any expenditure? Now what will happen? When the auditor will discuss all of these questions with the management, these will be answered as yes, no, and any. And at the end, once this checklist is completed, then he will evaluate. So he has in a way got his complete understanding, and that is also documented, which anyways is required to be done by the auditor. Another way, and which is very, very commonly found in respect of most of the large size organizations particularly, is flowchart. Now what is a flowchart? Flowchart basically gives a summarized view, or you can say a bird's eye view, about the processes, about the activities. So it's not a narrative form. In a narrative form, when the entity will have to explain a process, they will write a detailed description. They will write in detail as to how the process is moving. Unlike that, sometimes entities may have flowcharts through which they will explain this entire process to the auditor. And this is very commonly used by the auditors. And at times, if these are missing at the client place, auditors prepare their own flowcharts on the basis of the understanding that they would have received from the management. Okay. So this is how a flow chart will generally look like, and I'm sure you are familiar with this. So I'm just bringing it as an example to you. Yeah, clear? Okay, so these are some of the examples. So I'll just quickly move through some of these flow charts. Okay, so then comes the next part, that is about risk assessment by the auditor. I think that we have already discussed. And once this risk assessment is completed, once this walkthrough is also completed, then comes the next part, that is called as control testing. Now auditor has obtained all the understanding. Okay, in terms of understanding, everything is completed. But can the auditor rely on this understanding? No. Auditor need to corroborate everything by looking at the evidence, by looking at the underlying document. In relation to all these controls which may be existing in the company's internal control system, auditor needs to do a control testing. So auditor will pick up some controls on a sample basis. Means he will pick up some sample items in relation to each and every process, and he will test that. When he will do this testing, his focus is completely on the controls. Now you need to be very, very clear on this, because generally there is a confusion between test of control and test of detail. Test of control means the samples are tested by the auditor, wherein the auditor is only focusing on the qualitative part. He is focusing only on the situation that whether control is in place or not. Let me just give you one example for this. See, when an entity would have purchased an item of fixed asset, one fixed asset could be of a value of say 5,000. Another fixed asset could be of a value of say 1 crore. When it comes to auditor's assessment, auditor may also always want to pick up a sample of 1 crore. Why? Because this is material, this is significant. And through which what will happen? Auditor will cover significant part of the PPE or this particular item fixed assets. However, do you think that as in relation to the controls of the entity, there should be any difference when it comes to recording of an item of PPE which is of 5,000 amount or 1 crore? The answer will be no. The organizational control in relation to recording of a PPE should always remain same. Let's say an entity is receiving an invoice, and when this invoice is received of 5,000 and there is another invoice which is of 1 crore, can the entity say that for 5,000 items no physical verification should be done at the time of gate entry, or it should not be checked whether the invoice also has the goods or not, or maybe on the invoice the gate entry stamping has been done by the security guard of the company or not. This should only be done for 1 crore. Can it happen? No, because it's more of a qualitative analysis. It's about having systems in place, and the system will never say ignore small line and ignore the items which are of small value and ignore the items which are of high value. Systems will be put in place for overall functioning of the organization. That's why when the auditor will be getting into test of control, he will not be limited to only the material items, because it's more of a qualitative check for him. He is looking at the policies and procedures as compared to test of detail, wherein his focus is different. Clear? Yeah? And once this testing of control is done, then he will come up with a conclusion on the basis of testing that he would have performed, on the basis of the evaluation which he would have got, at whether the control is operating effectively or not. Okay. whether the control is operating effectively or not. When the auditor comes to a conclusion that the control is operating effectively, then he will get some comfort on the organization. So he will know that the controls are strong. So the financial reporting which the organization would have done would have less chances of error, as compared to a situation wherein he would have found that the control systems or the controls are not operating effectively. In such a case, he would know that there are a lot of problems in the organization. They don't follow any controls, they don't follow any policies and procedures. So definitely in their financial reporting, that system also, a lot of errors may exist. And what will happen? Because of this, he will have to increase his audit procedures. The extent of his audit procedures will vary on the basis of this evaluation or on the basis of this conclusion, that whether the controls are operating effectively or not. Clear? Clear on this? Yeah? So I think some of these points we have already discussed. And in relation to the control weaknesses that he will have, he will also note down all of those control weaknesses. Currently, auditors are also required to issue a report, give a report which is about internal financial control, wherein the auditor focuses on the controls which are relevant to the preparation and presentation of financial statement. Therein, this evaluation becomes all the more important on the part of the auditor, because on these internal controls which are in relation to the preparation of financial statements, auditor is actually required to give an opinion. Okay, clear on this? Yeah. So all of these reporting requirements are there on the part of the auditor, and even if the IFC report is not applicable to the auditor, even in those situations, auditor generally notes down the significant deficiencies in relation to the internal controls which may exist, and such deficiencies are generally considered and reported by the auditor, and which are also at times discussed with those charged with governance. Okay, fine. With this, we are done with our discussion in relation to this part of risk assessment and internal control. But just going through some of the points, if those are specific, I think we have covered that. Yeah. So now what I can do is I can just quickly get to your queries, and after the queries, we'll start with another topic. Okay, let me just see some of the queries which you may have. Alright, so Dipali is asking, sir, what's the difference between a checklist and a questionnaire? See, in a questionnaire, questions will be there, but checklist is more of like answering it in yes, no or NA, as compared to questionnaire. Questionnaire is more of a sort of, you can say, a narrative type of questions. Both of them serve the same requirement, both of them have a similar purpose. Idea is to obtain the understanding. Okay. So I would say conceptually two things are same as far as their objectives are concerned, but in terms of the way those are structured, in terms of the way the explanations are obtained, that is only different. Ricky is saying, sir, please help in understanding if any internal control is only working of one-off detection prevention or correct of misstatement like CCTV cameras is helpful only in detection of any theft. Is it also an effective internal control, sir? Yes, definitely yes. So when we say that this is not about prevention, it is about detection, that is also important, because in the internal control systems, it is important. Say if something is not prevented, at least it is detected, because if we detect that, say if we detect that the item has actually been stolen, okay, maybe an asset has actually been stolen, If that goes undetected, then will somebody be able to record that in the financial statements? No. And if the entity will have some mechanism of detecting it, then they will be able to do the correction, do the adjustment in relation to that item in the financial statement. So that's why both these things are important, prevention as well as detection. Okay, so Bhanushri is saying, sir, can you please give simple example in relation to the components of the internal control? Definitely. See, I think we have already discussed one example, and I would say you can just take up any example of any entity and talk about its policies and procedures. Okay, if I have just to quickly run you through this entire internal control system, if I pick up an example of sales, in relation to sales, what will happen? Some policies and procedures will be put in place, which will become applicable to the people, which will have to be imbibed in the people when they will have to follow a culture. Correct? And which should also flow from the top, which should be a communication from the top management. And those policies and procedures should have been discussed with those charged in governance also, because they also need to ensure that such type of controls are in place. You remember audit committee's role, audit committee's responsibility, they have this responsibility. So for sales function also they will have this responsibility. Now as regards its monitoring, who will have this responsibility? Again, it will be the sales department. So if the sales department is having some control mechanism, having some control system, they need to monitor it throughout the year. And if there are any changes which are taking place in that department, in that function, in relation to any of the new transactions, or maybe in relation to the existing transactions which are changing in substance, what do they need to do? They need to come up with new types of controls. And in relation to the existing controls, they may require some changes. Or even if the controls are there, if the departmental heads or if the relevant person are not checking those controls, are not evaluating that control, will that be of any use? No. Basically, you can just in simple terms understand that before the auditor will come, management also needs to do this control testing. And control testing is not only limiting to testing of sample items. No. Control testing means looking through this complete process, re-evaluating this complete process, identifying if there are any deficiencies, identifying if there are any improvements required, and of course, checking all of those systems which are in place. So this entire part needs to be done by the management. Right? Okay, then Monica is asking, can you give example of test of control and compliance of laws? So I think we discussed about it. We discussed that any organization will require some laws to be followed. Say on an entity, GST is applicable. Correct? You all understand GST? But some of their transactions are exempt from GST. Or you can say on some of their transactions, they cannot avail input credit. Now, who will check this? If nobody will know about this, then the accountant who doesn't know GST, what will he do? He will receive an invoice and he will pass an accounting entry. And what will be the implication? Later, when the GST audit will be carried out, or maybe during the time if any sort of assessment is done by the entity or for the entity, then there could be certain discrepancies in respect of in respect of this application of the GST law. Yeah. So this is something which may go wrong on the part of the entity in relation to compliance of GST. So what can be a check on the part of the management? What can be a control in relation to this? Management will set up a department, the GST department. This will be a team. Let's suppose of 5 people. who will first of all provide the required guidance to all those who are handling the matters related to GST, or who are handling the transactions as to how they should deal with GST in the context of whatever they are handling. Number one. And they will also be looking at the reconciliations. They also be looking at the records of the GST. They will also be looking at the records of the books of accounts as compared to GST. So will that be a check? Will that be a control in place? Yes. To this, what is happening? Entities ensuring compliance with a particular law. Okay. Similarly, there can be various controls. Clear? In simple terms, I think instead of getting confused, you should just understand a very simple term. That is about establishing a system in the organization. The moment a system in the organization is established, most of the things will automatically get streamlined. Okay? Then Saksham is asking difference between test of control and test of detail. It's not clear. Okay, yeah. So I was, expecting this question. Now, in relation to difference between test of control and test of detail, I just quickly touch upon this point once again. Yeah, because anyways we are running short of time. We are saying that when it comes to test of control, the focus of the auditor is only to check the controls. I'll take one example. There is a transaction of receipt of fixed goods. So two items have been purchased by the management. One machinery which is of a value of 5,000, another machinery which is of a value of 50 lakhs. Now in relation to these type of machines, when the auditor will test the controls, then he will not go by the amount. Why? Because the control of the management should be same, irrespective of the amount involved in an asset which is purchased. Because if an asset is getting purchased, let's suppose if the invoice is getting recorded in the books of accounts, at that time if the accountant is required to check on the invoice that this is signed by the guard at the gate entry, guard who verifies that at the time of gate entry, only for machine of 50 lakh and not for 5,000. This may not be appropriate, because this control in relation to checking of that asset, whether that has been actually physically received or not, should apply to all the assets. This should generally not be limited by the amount. Why? Because it's all about having the systems, having the policies and procedures which should apply to all. Therein we cannot say let's consider only significant items or insignificant items. That's why when the control testing is done, auditor is not impacted. Auditor is not focused only on high value items. Whereas when the auditor does a testing of detail, he wants to focus more on the material items, significant items, because therein his focus is different. Why? Because control testing would have already been performed by him. So test of detail is done by him after doing the control testing. Clear? Yeah? Okay, I think Gunjan, I'll have to come back to your point a bit later. Let's quickly move on to this topic, and after this topic, we'll just try to come back to some of your other queries. Alright? We'll just quickly get on to this discussion in relation to audit in an automated environment. And I'll just try to link this with some of the points that we have already discussed. See, when it comes to automated environment, what are we discussing here? We are discussing about the company or the organization once again. Have we talked about the organization? Yes, multiple times we have talked about the organization. Now, an organization When we have discussed, okay, let me just go back to my discussion on chapter number 3. Let's suppose when we were discussing about the organization, we discussed about their processes, we discussed about their risk assessment, we discussed about their controls. Did we limit ourselves to manual controls? Or did we say that we are only discussing controls which are manually run? No, I don't think we did any such segregation. Can you all tell me quickly, please? Say yes or no. Did I limit to only a specific type of process? Did I limit to only a particular type of risk or only a particular type of control? Quickly, can you tell me? Or did I discuss about entire organization as a whole? Tell me quickly. So we discussed about understanding the processes. We discussed about understanding the organization. So were we limited in that discussion? Quickly, please, all of you. Yes. Just awaiting your responses. Nobody is responding. What has happened? Quickly, we don't have so much time. You need to answer this quickly. Yes or no? No response. When we discussed about the risk assessment, when we discussed about understanding of the organization, when we discussed about understanding of the processes, do you think we were limited to only the manual controls? Okay, finally I have started receiving responses. Seema, Bhanushri, Jinal, they are saying no, we were not limited. So what does it imply? Basically, I'm just trying to link this chapter to chapter number 3. And I can just show you that most of the things in this chapter are what we have already covered, and that is how you should also plan your revision. So when it comes to automated environment, we are talking about one process of the organization. Now, process of the organization, the way it is understood, the way the risk is assessed, the way controls are considered, will always remain same, the way we have just discussed in chapter number 3. It will not change. Let's understand why is it that I'm saying, why is it that this is important. Let's talk about any process of a company. Talking about a sales process. In relation to a sales process, there could be some controls which are run manually. Manually means on which, say, a sales invoice is generated, and when the sales invoice is generated, a hard copy of this should be printed and this needs to be signed by the sales head. What is this? This is a control, but this control is manually done. These days, considering the environment of the entities, all the controls are not done manually. All the controls are not run manually. Let's understand another type of control which is possible. There could be a control wherein whenever any sale invoice has to get generated, okay, so the system has a programming wherein price list against each and every finished good is available in the system, and whenever any invoice has to be generated, so the system will automatically pick up the MRP of that item from the price list. So that means if a person will start generating an invoice, this price will automatically get captured from the price list which is also existing in the same system. So it's a type of control. Why? Because this person who is generating the invoice, he will not be able to change the MRP. He will have no choice but to follow the same MRP. He may want to change this for different reasons, but the system will not permit it. What is this? This is also a type of control. Correct? But is this control manual in nature? No. This control is established in the system, in the computer system, in the IT environment. And these type of controls are called as IT controls. So when it comes to an understanding of the organization, every time the understanding of the organization will involve both the aspects. the manual processes and the automated processes. And manual and automated processes will exist for each and every process. Means in the sales process, there could be some manual things, there could be some automated things. Similarly, in the payroll, there could be some manual processes, there could be some automated processes. Similarly, in procurement, there could be some activities which are carried out manually, and there could be some which are happening through the system automatically. So the understanding will have to be obtained for all of them. Once the understanding is obtained, now comes the next part, that is called as risk assessment, which the management would have done. Auditor need not do that. Management would have done. So when the management will do this risk assessment, can we say that the management needs to assess the risk only for manual activities or only for the manual processes? No. It needs to be done for all the activities, which will also include IT activities or the IT processes. That means what will happen? Similar to what we discussed in chapter number 3, same way risk assessment will be done for IT or for the IT process. Then comes the control. Now when it comes to the control, can we say that the management may not have controls which are in relation to the processes which are automated? No, it's not possible. For the controls, we cannot have this limitation. So if the processes are automated, definitely the control should also be put in place. Or even if the activities are manual, there could be some automated controls which may be put in place. Yeah. So when we talk about understanding of the entity, risk assessment, or the internal control evaluation, then irrespective of the type of process, the control mechanism will work in a same manner. Clear? Clear on this understanding? Clear on this understanding? Now the IT environment of the company could be running in a different manner, or it may vary from entity to entity. And does it impact us? No. An entity may be small in size and it may be following tally. In that case, auditor will go and understand the tally system. An entity may be following a SAP package, in which case most of the processes could be integrated. Most of the controls could be automated. Again, in that case, what will the auditor do? Auditor will need to understand the IT systems, because most of the activities in relation to financial reporting will also be dependent on the IT system. So that's why it will become important on the part of the auditor to understand those IT related activities, to understand that processes related to IT, to understand all the risks which are attached to that IT system of the company, and to also understand the controls which the management may have put in place in relation to all of those IT environment. Now, in relation to the controls, there can be a bifurcation. Depending on the systems of the organization, or in relation to the systems of the organization, the controls can be bifurcated into two parts. Okay, so now we'll discuss about the types of controls which are related to the IT environment. Just give me a couple of minutes. I'll just be back. I'll just need a couple of minutes, and then we'll continue our discussion on the IT control. Just a couple of minutes, please. Okay, so before I discuss on this, I think I just looked at one query which has come from Dhaval. Dhaval is saying, sir, I have been sharing my queries, but somehow those have not been reaching you. And I think somehow those have been getting missed, and he has been facing this problem from last 4 or 5 days. See, as regards this query in relation to your remaining sessions, I'll just tell you that whenever you send any query, you need to just check whether that has been successfully sent or not. If that is sent, then definitely the query is reaching us. Okay, and if this particular query I could read out, that means definitely your query is reaching us. Okay, Dhaval? Yeah? Okay, now moving on to the types of controls. So these types of controls could be into two parts. It could be the general IT controls or it could be the application controls. Now let us discuss about the general IT controls and about the other type of IT controls. So I'll just quickly take you to the general IT controls so that we can also have some examples over there. So moving on to the just give me a couple of minutes. Just go to the relevant part. Okay, yes. Now what are these general IT controls? General IT controls basically relate to organization as a whole. Means these will apply to entity as a whole. For example, policies and procedures. When we talk about policies and procedures, are those limited to any particular department? Are those limited to any particular function? No. They apply to entity as a whole. Now, what can be a policy or procedure? There can be a policy of the organization that each and every employee in the organization should have a valid user ID and a password which is meeting the certain parameters. For password, again, parameters are prescribed. What do we talk about this type of control? This is a control which is not limited to only a particular application. This is a control which is not only limited to sales transaction. This is a control which is not only limited to processing of payroll. This is for all the employees as a whole. These type of controls which are about policies and procedures that may relate to many applications and that support the functioning of the application controls or functioning of various applications. These are called as general IT controls. For example, when we look at the controls related to the networking. Now networking is what? Networking is one way through which various users in an organization will be connected to each other. This is not an application. This is basically about an IT system which is applying to everything as a whole. When we talk about server, there is a process or there is a control which is followed by the entities which is called as disaster recovery plan. I'll just take this example to explain you. So what is the control? Server is the one on the basis of which this entire IT functions. Correct? Now this server, let's suppose if this is destroyed or this is impacted because of say natural calamity. Say there is an earthquake. So what can be a control which can be put in place by the management? Management should have a backup of this. And when the management needs to have a backup of this, what they will do? They will just put a backup of this server at some other location which may be having or which may not be in the same seismic zone, which will have different risks in relation to this particular natural calamity. When it comes to such type of controls, what are these related to? These are related to organization as a whole. So whenever an auditor will look into the controls, he will focus on the general IT controls. Because if the general IT controls are missing, if these are not operating effectively, then they will impact the entire functioning of the organization. Next type of controls are the ones which are called as application controls. Now what are the application controls? These are the ones which relate to various applications. Various applications which may be used by the organization. Various applications of the information system. Various applications of the computer system. That means these controls are specific to that particular application. For example, when we talked about picking of this MRP from the sales price list whenever any invoice is generated, what is this type of control? This control is specific to this particular application. This type of control is called as application control. This is automated, but this is application control. So whenever we look at all these types of controls in an IT environment, we need to focus on both these type of controls. Then there can be another type of controls, IT dependent controls, that are basically manual controls that make use of some form of data or information or report produced from the IT system and applications. In this case, even though control is performed manually, design and effectiveness of such control depends on reliability of source data. Let's understand what can this type of control be. Say the company wants to compute the provision for bad and doubtful debts. Okay. Now this will be done by them manually. So they want to analyze each and every debtor on which they will create a provision. It's a control. It's a manual control that there's a person who will evaluate each and every debtor in terms of his recoverability and create a provision. So this will be done manually. But the person who will do this evaluation, he wants one aging report of the debtors. Means he will obtain a listing of the debtors which will be segregated or which will segregate the debtor on the basis of their aging. Means how many of them are 0 to 30 days due, how many of them are 30 to 90 days due, how many of them are 90 to 180 days due. Now this listing is generated from the system. Let's suppose if the system doesn't generate this listing accurately, will the person be able to assess this provisioning accurately? No. These type of controls are called as IT dependent controls. Okay, clear? Whenever we look at the IT environment, general IT controls are very, very important. Application controls are important, but generally IT controls are more important. And there is also a relationship between this. Why? Because application controls are actually facilitated by the general controls. If the general controls will be missing, then we may not be sure whether the application controls are running effectively or not. So that's why whether application controls run effectively or not, it will not impact the general controls. But if we assess that the general controls are not operating effectively, then definitely application controls will have an impact. Okay. So whenever auditor will come across a situation wherein he will find that the general IT controls are not operating effectively, he will lose control. He will have to get into a conclusion wherein he will say that the operating controls are not operating, that the controls of the management are not operating effectively. Yeah, and once this evaluation is done, what will be the next step? The next step again will be same for the auditor, and that will be to do the control testing. And when he will test controls, again he will not be limited to the manual controls which are in relation to manual processes or which are in relation to manual controls. No, he will be testing both. He will be testing automated controls. Automated controls means the controls in relation to all of these IT part that we have discussed. And similar to what he will do in case of his conclusion, once he has tested all of these controls, then he will evaluate whether the controls are operating effectively or not. So he needs to do this activity for both of them. These days, auditors are also making use of information system increasingly for the purposes of carrying out their audit procedures. That's why they also have certain tools which are helping the audit procedures. Okay, some of these tools or some of these softwares which they use are very commonly used by some of the large firms also. For example, one of the tool or one of the software could be IDEA, which helps the auditor in assessing various things, which helps the auditor in sample selection. Okay, so some of these things are used by the auditor, but the end result is one. He needs to get to a conclusion through which he can give his opinion about the true and fair view on the financial statements. Right? Yeah. So this is it that we had on the. This is it that we had on the discussion related to the IT environment. Great, and I think with this we are also done with our discussion in relation to whatever is planned. Yeah, before I get on to the queries, I'll just quickly request Karuna to share some points with you, because I understand most of you will be looking to move now and will not stretch this session. Don't worry about it. Yeah, so I'm just requesting Karuna if you want to share some important tips with the students now.
Yeah, dear student, Achal has very nicely explained you the topics, and you need to revise, you need to prepare your notes, you need to practice with the help of mock test paper as well. After writing, you can analyze with the suggested solution which we have hosted on the website, and we will be having a session on the same in the month of June, of which detail is also hosted on website. You may please go through the same. And one more thing, in the evening we will be having again audit report topic, and we'll be having question answer session on engagement and quality control standard, and we'll be having a past president with us and director of studies for your queries. So be with us in the evening 7, and thank you very, very much, Achal. You have very nicely explained, and I think students, you are also very happy for the same. In case if you have any query, you can ask from Achal, and if any of the queries unanswered, you can write to us on auditing-final@icai.in is given on ICAI website also. Thank you. Thank you, Achal. Over to you.
Yeah, thanks, Karuna. Okay, so I can just look at some of the queries of the students now. Divya is asking, is the audit in... okay, so I think this is something already answered. Haripriya is asking, can you explain manual controls? See, when I talk about a control wherein the guard is checking whether the asset is physically received at the time of purchase, this control is manual. In this case, no IT system is getting used. As compared to another control wherein we are saying that the sales invoice will pick up the sale price automatically from the system. That is automated control. So that is how you need to differentiate between them. Then thanks to all of you, of course, I think some of you want to move. All of you who are just moving, thanks to all of you from my side. I think this query is coming from Kunal. List of... So I'll just move on to this query a bit later, Kunal. If there is any other query from any of you, please let me know, because I can understand this query of Kunal, but I would just request Karuna to answer this maybe a bit later. But before that, if you have any such query in relation to the topics that we have discussed. Okay, Bhanushri is asking, can a client apply for quality review of a firm as he is more interested in the quality of his audit? See, this option is something which is available in respect of peer review and not in respect of quality review. But as regards the quality, okay, this is something which generally doesn't happen by the client side. Generally, this is picked up by the regulatory side. Whenever client will be interested in all of these things, okay, then they will also be doing this evaluation. If you remember, we discussed about the audit committee. Audit committee has a role to play with the auditor. And audit committee has this role wherein audit committee evaluates the quality of the auditor. So to that part, client always captures the quality of the auditor. So this is something which is always done by the client internally. Even if I talk about a very small organization today which may not have any audit committee or which may be very closely held, wherein the board of directors will also say bookish because it's more of promoter driven, wherein the promoter will be evaluating the quality of the auditor. Because what is an audit? Audit is actually a service which is provided by a professional to the client. So whenever any service is provided, it is evaluated. For example, you are receiving this lecture. what is happening? You are receiving this service. So when you are receiving this service, you would know whether its quality is good or bad. Okay, accordingly, client will also know when he is getting this service whether this is good or bad. Yeah, that is how this is generally tagged. I'm just talking about more of the practical application around it. So then I think I'm not getting much of the queries. So I would just request Karuna, there's just one query which has come from Kunal. Can you give the list of some important essay from examination point of view for May 24 old course? So I'll just add this to old course as well as new course.
Dear Kunal, and in fact, all the students, as such, there is no important standard because at CA final level, if we are getting any question which is evaluation and synthesis based or application and analysis based, in that question there might be mixture of 2 or 3 standard. It can be of essay 200, 210 or 220. It may be on 300 series which is based on risk assessment, and audit evidence series, of course, very important. And at the final level, when we are covering as a 600 series using the work of others, expert and internal auditor, that is also covered in our study material. And 700 series is audit report, which is again a very important series. So it's very difficult. We cannot say which are the important standards. So I would like to request you ki please go through at least bare standard, and as I told you yesterday, you prepare your own flowchart in which you start with one, name of the auditing standard, second, what is scope and objective, and third thing, what is auditor's role and what is auditor's responsibility, and how auditor will deal with specific situation if it is given in the standard, and how auditor will report. These are certain criteria on which you can prepare your flowcharts or comparatives in Excel sheet so that at least you will be able to revise it faster. But please don't go for others prepared flowchart. You read once bare standard and prepare your own flowchart and then study. Then you will be able to answer all the required points which are asked in the question paper. So as such, there is no important standards list. You need to prepare all, because now we are having MCQ based question paper also. So you never know on which standard there will be a question. So please prepare all the standards. If you are finding it difficult, in a day you can do 2 or 3 standard. In next day, you can just revise that flowchart and again you can prepare for 2 or 3 standard. So in that way, because we have now removed 800 series, SAE, SRE, SRS, all are removed. So SQC1 and SA 700 series, the standards are being applicable for you, for old as well as new syllabus. So please segregate it and prepare accordingly. Over to you, Achal.
Yeah, sure. So I will receive some queries in between. So Hina is asking difference between general IT controls and IT dependent controls. There is no difference between these two. In fact, the segregation is a bit different. So one is general IT, I didn't read this word general. So when it comes to general IT controls are more of about the policies and procedures around the organization. IT dependent controls are not about this entire organization as a whole. You can say it's about particular activities or a particular application. For example, we discussed that the debtor's aging is getting generated from the system, it is getting manually tested. Okay, this is related to a particular application as compared to general IT control, which will apply to organization as a whole. Let's say, for example, entity has a policy that each and every employee will have a system password. So let's suppose if some of the employees are not following the system password, they just do away with the system password. Anybody can just access their systems. So what will happen? This may result in loss of data. So this is something which is applicable to entity as a whole, and this is not limited to a particular application. So that's the difference between these two. I think Saksham, I have already answered your query with this answer which Hina is receiving. Gunjan is asking, what is the difference between substantive analytical procedures, under substantive procedures and analytical procedures, under this auditing standard. So I'll just try to explain all of these three items one by one, and I think automatically you'll understand the difference. Substantive procedures include two procedures broadly. One is analytical procedures and second is test of detail. Okay, so that is the meaning of substantive procedures. And this comes after the control testing. So we have this stage of control testing and then we go on to the substantive testing. So this is about substantive procedures. Now within those analytical procedures, there is a way to analyze the things. For example, during the year, we compare the sales of the current year are compared with the sales of last year. So we find that the sales have increased by 10%. Now this will be further analyzed by the auditor. Auditor will check why the sales have increased. This could be because of two reasons. Maybe the sales quantity was more in the current year as compared to last year, or maybe sales prices have increased in the current year as compared to last year, or maybe it's a mix of both. It is a combination of both. This is an analytical procedure which will give some insights to the auditor in relation to his audit procedure, in relation to understanding of that particular item. However, when the auditor will do this analysis, he will find that the prices have actually increased during the year, or he will get this understanding that actually quantity has been sold more in the current year. He will corroborate this by looking at the evidence. So what can he do? He can look at the current year's prices on a sample basis, and he can also check the prices of the last year on a sample basis, through which he will substantiate this understanding that he has obtained by doing this analysis. And that is called as substantive analytical procedure, there wherein you are substantiating your analysis by looking at any audit evidence. Okay. Then I think the next query is coming from Gunjan. Gunjan is saying, what is meant by assertion? See, assertion is not something which is easy to understand. You can just simply understand in this way that it's a way auditor wants to audit. Okay, it's the perspective which the auditor will pick up for audit of any particular line item. For example, let's say auditor wants to ensure that all the items of sales transactions have been recorded during the year. Means none of the item has been missed out. So this is what he wants to check. So this is one way he wants to check. This is one way he wants to apply his audit procedure. This becomes his assertion, and this assertion is called as completeness. Okay. Let's say auditor now wants to check that no sales of the future years have been pre-booked in the current year. So again, it's a way he wants to apply his audit procedure. It's a perspective which he has picked up in relation to performing his audit procedure. This again becomes an assertion, or you can say this is called as assertion technically, and this assertion is called as cutoff. Third, wherein auditor wants to check that the revenue is recognized, which should have been recognized, but is it recognized at 100 instead of 200? Because ideally it should have been recorded at 200. So is it getting recognized at 100 or 200? That means he wants to check the amount, which is called as valuation. Okay, so this is what is meant by assertion. Gaurav is asking, I missed my query. I think I missed this query yesterday. Do the LODR regulations have an overriding effect over the Companies Act? See, generally, whenever you look at the two regulations, they will not have any contradiction. Generally, they will not have. Okay, generally, these are aligned. In fact, generally, they may be duplicated. Maybe one regulation is saying something and the other regulation is also saying the same. Generally, this is what happens. In case there is any contradiction, it is always clarified by the other regulation that in case of contradiction, what will prevail. Okay, so I will not say this is something which is overriding. Okay, then Vasudha is asking, GST audit fee can be claimed in the P&L. Means can this be recorded? It's more of an accounting thing, huh? So definitely you can record. It's like any other expenditure. For example, statutory audit fees you'll record. So you'll also record the GST audit fees, and you can definitely claim it. It's like any professional expense. Yes, you'll get the slides, Vasudha. Don't worry about it. And Vasanti, I think I'll have to come back to your query a bit later. Let me just quickly read the query of Kunal. Otherwise, I'll lose this. Kunal is asking, in case of peer review certificate is valid for 3 years, person is appointed as auditor for 5 years for listed company, but suppose his certificate expires at 3rd year and for some reason his peer review was not done during the 4th year, will it lead to vacation of office during the 4th year? Since for listed company a person should be eligible and should have peer review certificate, since as per the Companies Act there is no. Yes, I understood your point. You are saying that somewhere in between if the validity is not there. See, whenever the auditor will be appointed by the company, it is not only on the part of the auditor, on the part of the company, it is on the part of both the parties to ensure that the auditor is eligible. So when the company will appoint the auditor, auditor should be validly eligible for this appointment, which will require him to have this valid certificate for this period throughout the period of appointment. He will not have that, then he will take this beforehand. Because this situation will not arise when he will see this certificate getting expired, because he'll know validity date is something which he'll know even today when he's getting appointed, when is this going to expire. Okay. Then Vasudha is asking, GST audit reconciliation have big differences on sales quantity to settle that we have to give annexures. It may happen. Okay, it is not necessary to give annexures. An annexure is something which may or may not be required. In case the difference is not there, then there is no point in giving the annexure. But when it comes to the GST audit, as I told you, it's all automated. Okay, you don't have this manually done now. The reconciliation statement which I showed you, I also picked this from the system. I downloaded that from the system. And that's why you were seeing that in Excel file. Otherwise, it's all automated, and therein you will see this reconciliation statement, okay, which is actually existing over there. So you may or may not fill any input therein, which is fine. Then I think I'm not getting any further queries. This other query which is coming from Vasanti. Vasanti is asking, please explain about the guidance note. It is more elaborate, say 40 to 50 pages. How do we study that from the examination point of view? Okay, so that's the concern. So I would request Karuna if you can just share some tips around the study of the guidance notes. Karuna, if you're around.
Yeah.
Yeah. So Vasanti has a query. Vasanti wants to understand how to prepare for guidance notes, because these run into 40 to 50 pages. How do we study it from examination point of view?
I know it's running in 40, 50 pages. In fact, guidance note on audit of bank is in much more detailed pages. But what I would like to say that you can segregate, like you can restrict yourself. In the beginning, you can go for 10, 20 pages. The next day, another 20 pages. And whatever important, you just highlight that. And accordingly, you can prepare your notes. So it will take 4-5 days or 6-7 days, but it will be very good and compiled manner. Then you will be able to answer the questions which are based on guidance notes. Earlier, there were so many guidance notes, but now it's very lesser now. 4-5 guidance notes are only applicable for your May 2020 examination, which is now scheduled in July, August. So I know auditing is a very vast subject and it's multidisciplinary also. For this subject, we need to prepare many more subjects also, like accounting. It should be on tapes, law, then Chartered Accountant Act, regulations, of course, peer review, quality review, then LODR, listing order disclosure requirements, tax audit, direct also, indirect also. So it's multidisciplinary, it's very vast also. So don't try to complete it. Don't give 4 days for auditing or 7 days for auditing. If you can divide it, you will be doing it more interestingly and you will be revising it more and more. And when you are revising more and more and when you are attempting mock test paper, you will be able to solve the questions. You will be practicing a lot. Then you will find it interesting and you will be able to capture in your mind also and you will be able to answer in the examination also.
Okay, so now I think a couple of more queries are left. I'll just quickly answer this. Monica is asking, apart from password, can you give another example for general IT control? If you remember, we discussed about disaster recovery plan. That is also an example of general IT controls. Okay, it could be related to the networking. Maybe the networking, the controls which have been set up by the management in relation to the network. Okay, that is again about the organization as a whole. Okay. Harsha is asking, is walkthrough same as the audit trail examination? No, these two are different things. When it comes to the audit trail is something which is in relation to the work of the audit, as compared to walkthrough, wherein the auditor just wants to have the discussion. It's similar to what you keep asking us. Whenever you want to understand any concept, you say that please give us one example. Please give us one live situation, or please take us through this situation once by taking this example. I would relate walkthrough with a similar sort of thing. It's about understanding that particular transaction process or the controls by actually looking through one sample or by actually looking through one transaction. Okay. Yeah.
I think time is to wind up because we are.
Yes.
Yeah.
Yes. Sure. And I think we are also done. We don't have any query left, thankfully. And in case something is left, you can definitely capture in the evening session.
Yeah.
So with this, I would just like to thank all of you, all the students, and thanks Karuna also. Your tips in between were very, very helpful. And thanks so much, and all the students for your examination. Thanks so much.
Thank you, Achal. Thank you very much. And students, all the best. Be with us in the evening at 7 p.m. We are having our last session for auditing subject. So we'll be meeting again in the evening, 7 p.m. Thank you very much, Achal. Thanks a lot. You have very nicely explained. Thank you.
Thanks. Thanks, Karuna. Thanks once again to all the students. Thanks so much.